a viable resistance level. Okay, hope that makes sense. And this is another way where we can, let's say we have a huge rally and then we begin to have a consolidation. The bottom of the consolidation can be looked at as support. The top of the consolidation can be looked at as resistance, and we're going to purchase it, right? Purchase when price actually breaks the resistance level, okay? Because it suggests that now there's way more buyers than sellers at that resistance point, right? We had a lot of selling pressure when price hit that resistance before, but now that selling pressure has seemed to disappear. It's no longer there. And that's when we actually buy it, because now we have confirmation that there are actually way more buyers than sellers. And you can kind of pair this right away using the breakout method, right? This is a breakout. We're playing above the consolidation. So you can kind of see how support and resistance can help you with your breakouts and breakdowns and how they kind of relate to one another. Okay, now looking at another example when, let's say, we actually have an uptrend, right? So let's say we have a rally and then we have a pullback. That high, the previous rally high right here, is now going to serve as resistance, right? So now this is resistance, okay? And then let's say we, from there we also continue, we have a pullback, right? And then we break the resistance, we continue to rally, okay? And we begin to actually pull back again. What we want to see is we want to see this prior resistance from here, right? This prior resistance now turn into this pullback's support, right? So here, the resistance level, right? This resistance level from this high is now turning into the support for this low, right? So this resistance is becoming this support now. So this is really what we kind of want to see during uptrends, okay? So exactly like I mentioned, this is the resistance level. It turns into this pullback's support. And during these retracements, right, like this pullback is technically called the retracement, we want it to retrace 40 to 60% of the prior rally, right? So we have this rally. We want this retracement to be, we want it to retrace 40 to 60% of this rally, which it has. I mean, this kind of retraced around, I would say probably right around 50%. Okay, and we want to see that retracement be between 40 to 60%. We don't want to see deep retracements. We also don't want to see super shallow retracements. Okay, and we kind of talked about that during the buy setup classes. Okay, and the whole idea of this turning, this resistance now turning into support is that we want price to actually retrace to the prior resistance level, which is now being considered as support, right? We want price to retrace to this resistance, and once it does retrace and respects that resistance, it becomes support. Same thing here. We have a rally, right? We have this prior resistance, and we retrace back to that prior resistance, now therefore making it support, and we rally again. So this is something we want to see this during uptrends or downtrends, right? We want to see retracements that retrace to the prior resistance, okay? Just like, and we're going to examine a downtrend as well, right? Where we have a drop, then we kind of have a retracement here, a rally higher, and this support level, right? This support level right here is now becoming, this retracement's resistance level. So this support here, right, is now becoming resistance for when this stock, after this drop, it's going to become resistance for this retracement or this rally higher, right? So it's the same thing. This support level becomes resistance here, and we want price to retrace to the prior support level, right? This was the prior support level. We want it to retrace to the prior support level here, and now it's turning into resistance. We also, like I said, just like same thing, we want a 40 to 60% retracement, right? This is a drop. We want it to retrace 40 to 60% of this drop, right? Straight to this new resistance level, which was the prior support. Okay, and it's basically the same idea. This is what we want to see during a downtrend. We want to see retracements to the prior support, which is defined by this low, right? Same thing here. We have a drop, right? And then the retracement, and the retracement, it goes right into the prior support level, which is now resistance. Okay, hope that makes sense. And we are actually going to head into the conclusion here. So support and resistance is a very important tool and resource that you can use to benefit your trading, right? And what we should do is combine support and resistance with other strategies, with the other information that we are learning in this course. And a huge mistake traders make is that they solely trade and rely off support and resistance levels, right? They only use them, which is foolish, right? Support and resistance is incredibly useful when we actually pair it with other strategies. That's the key thing. That's the key here. We're pairing it with other strategies. We're not just using it by itself, okay? We should not be trading anything in a vacuum. We shouldn't be using one piece of information. We should be using a collection of different factors, different strategies that we're learning in this course. And once, using that collection of strategies, we're able to make a lot more higher quality decisions, a lot more higher quality trades. So please use support and resistance to your advantage, but don't solely use it. And you should be combining support and resistance knowledge with other strategies for the best results. And I'm going to include a video next, actually looking at stocks in practice, looking at real stocks, drawing support and resistance lines, and kind of trying to analyze what we learned during this presentation in theory. We're going to try to bring it into practical knowledge, okay, and into more practical application of support and resistance. So that's in the next video, okay? And I will see you guys in the next class. Thank you. Alrighty, let's dive into more ways we could actually use support and resistance to our advantage. And we're going to kind of get into the more practical elements of using support and resistance. So I've made a few examples in the slides. And in the next class, I'm actually going to be looking at real stocks and showing you how you could apply some of these support and resistance, teachings, all this education that you've been seeing, how we could actually apply it into real life charts, okay? So key points, and specifically for, determining targets in this case, we're going to be talking about how to use support and resistance to determine targets. Some key points is that, determining targets and determining, where you think a stock is going to rally to or where you think a stock is going to drop to. It's based completely off support and resistance, right? And if you're playing long, right, you're buying a stock, what you're going to want to do is check the next resistance level and use that as a potential target, okay? And if you're playing short, you're going to want to check the next support level and use that as a potential target, right? So our targets are simply based off looking at support and resistance, all right? And what you're going to want to really do is look at several different time frames, right? Because let's say you're trading off the 5-minute chart and you don't see any resistance above. Let's say you're playing long, right? And you don't see any resistance above on the 5-minute chart. Well, what you should be doing is looking at the higher time frames and then seeing if there's resistance, because you might not see resistance on the 5-minute chart. But if you go to, let's say, the hourly or the daily chart, you might end up seeing resistance, and that's going to affect whether you're actually going to take that trade or not, okay? So, like I said, we're going to be looking at higher time frames to check if there is support and resistance above or below. And you're going to, in general, you're going to want to, look at the higher time frames. So specifically the daily chart and the hourly chart. I wrote daily chart here, but you could also check the hourly, right? So always check the daily chart first, right? Or you could check the hourly first and then the daily. It's really kind of up to you. But you're going to want to check the daily chart and determine if there's enough room for the stock to rally or drop to the next resistance or support level. Ultimately, when let's say we find a trade that we like and we're trying to figure out targets and we're looking let's say we're playing long and we're trying to figure out the next resistance level. And so we take a look at the daily or hourly chart and we determine what the next resistance level is. We have to then ask ourselves, based on, the size of our stop loss or the size of our risk, is the trade worth it? Is there actually that much room for the stock to go up before hitting resistance, right? Or is resistance literally directly above, right? And if resistance is directly above, well, that's when the stock, assuming it hits resistance, that's when it's going to have a tough time, continuing higher, right? Because if it's hitting resistance, you can think of that as kind of like a ceiling, right, for the stock. So, or if it's hitting support, that's kind of like a floor for the stock. So it's going to need, additional, I guess you can call it effort, or a lot more additional buyers for it to actually rip through resistance, right? So our goal is to make sure there's an ample enough room before the stock actually hits resistance, right? So before there's actually enough, room for it to go up for us to make a profit before it hits our target or resistance. So just to reiterate, if you're playing long and you see that there's a resistance level directly above, you should reconsider taking that trade, right? Or, maybe, rethink the trade a little bit, because if there's resistance right directly above, there's really not that much room for the stock to go up before it hits it, right? And that's gonna, decrease your reward to risk. And if you're playing short and you see that there's a support level directly below, well, you're gonna want to reconsider taking the trade. Because if there's support directly below and there's not that much room for the stock to fall until it hits support, your reward to risk might be affected. And this, of course, all depends on the actual what your actual stop loss is, okay? And I I went a lot more into detail with this in the risk management video, so definitely go back to that if you're having some confusion around this. And something else I want to talk about is what I want you guys to do is check for overlapping candles. Overlapping candles, or you can call it maybe a consolidation or a base, that represents resistance or support. So let's look at this example. Let's say we have a stock, it drops, then it begins to consolidate. And after this consolidation, it continues lower, right? And let's say here, we're looking at potentially playing this long. This is just an example, right? I'm not saying it only applies to this situation. This is just an example. We're playing long from the bottom and we wish to determine the next resistance level, right? We're playing long and we're asking ourselves, what's the next resistance? Well, we're going to look at the next area of overlapping candles. And these overlapping candles, they can represent support or resistance because it kind of represents an area of uncertainty, right? Where we have a drop and we kind of have a consolidation. Some people ended up playing long here. Some people played short. And, let's say someone who played long, they ended up getting stuck in the position and it ends up going against them. As soon as the stock ends up, reaching back to their entry point, because remember, if they're playing long from here and then it ends up dropping, they're down on the position. Let's say they don't exit and the stock goes right back up. Well, they might end up looking to get out of their positions, break even. And there's a lot of different details, there's a lot of uncertainty that occurs during these consolidations. So that's why we use it as support or resistance. So when looking at something like this, if we're playing long here, we're looking at our next target is the next resistance, which is these overlapping candles. So this is just an example of, how to determine if something is support and resistance. It's check for overlapping candles, okay? So this is definitely one way to look at resistance or support. This is another example here where, I kind of talked about assessing your risk using support and resistance. Well, this is a really good example where we have a consolidation, right? We have a bunch of overlapping candles. Then we get a tremendous drop. Then we get a rally, and all of a sudden now we have a breakout or a base breakout, potential for a base breakout. And our entry is over the base, our stop loss is under it. And where our next target, well, it's going to be the next resistance area, which are these overlapping candles, okay? So this is going to be our first target. right? So what we have to assess when looking at a trade like this is, okay, what's our entry? What's our stop loss, right? Then determine the size of the stop, which we would, subtract the stop loss from the entry point, right? So let's say our entry is $4, our stop loss is $3.90. That's a 10-cent stop. And let's say, right, so our entry is $4, our stop loss is $3.90. Let's say our target is, let's say 410, right? This resistance starts at 410. Well, our entry is at 4, our stop loss at 3 is at 390, and the next target, the next resistance area, our first target is at 410. Well, at that point we're risking 10 cents to make 10 cents, right? So obviously that wouldn't be worth it, because, after watching the risk management video, you guys should know that our risk should be 2 to 1, right? So let's say our entry is at $4, our stop loss at 390. That's a 10-cent stop. We want to make sure that there's at least 20 cents of room before it hits the first target or the first resistance area. Okay, I hope that makes sense. Like I said, watch the risk management video if you're still kind of confused on that. But now that we know how to determine our targets, right, how to determine what the next resistance area is, we can now manage our risk a little bit better, where we're trying to assess, okay, what are we risking versus what's our potential reward. And our potential reward is, well, however much room there is between our target, right, or resistance area from where our entry is. And, I just want to reiterate here, this is a base breakout, right? We play long over the base and we place our stop loss under the base. So long over the base, stop loss under the base. The target is the next resistance level, which are the overlapping candles above. We must consider whether our target is worth the risk of taking on the trade. We just talked about it, assessing the stop loss, assessing where our targets are. And refer to the risk management video. We want the potential of making 2 to 1 return or 2 to 1 reward on our risk. Okay, so I hope this makes sense. This is just an example of how we could apply resistance and support, where we're looking at the next resistance level for our target, and then we're determining whether the trade is actually worth it, dependent on our actual entry and stop loss. Okay. And another another topic I wanted to discuss is, if a stock is rallying into all-time highs, there is no resistance to the left, right? It's into all-time highs. The stock has never been at that point before, because it's, like I said, it's all-time highs. So there is no resistance to base our targets off of. So we cannot accurately determine our targets. Just like if a stock is dropping into all-time lows, there's no support below and to the left. There is no support because the stock has never been at that price before. So therefore, we cannot accurately determine our targets, right? So if the stock is into all-time highs or all-time lows, we're not going to be able to determine targets that well, just because there is no support or resistance to base that off of, right? And as a general rule, this is really going to help you understand where there is support resistance. Is always look to the immediate left for support and resistance. And that's a key word. Look to the immediate left, right? And this is one of those things that it's all about practice. It's all about actually looking at some charts and looking at support and resistance. But like I said, we're going to be looking at the immediate left for support and resistance. And what I want to do is actually go through a bunch of real life charts and give you guys some examples of all of the theory that we have learned about support and resistance, looking for overlapping candles, looking for targets, trying to assess risk to reward using support and resistance, right? Looking into some all-time highs or lows, and also looking to the immediate left when analyzing support and resistance. So the next class, I'm going to be looking at specific stocks, and I'm just going to analyze, draw some support and resistance lines, and show you some of the theory that we have learned so far. See you in the next class. All right, guys, we're going to go over some real life examples, some real life charts, showing you guys how to apply some of the support and resistance theory and knowledge that you've just obtained, okay? And we're going to be first looking at Facebook. I kind of picked random stocks. So these weren't pre-selected. I kind of just found a list of random stocks that we're going to go over here today. And just one example, looking at this, let's say you're looking at this and you're looking at potentially taking a short, right? Let's say it dropped where we had a big drop here. It's kind of consolidating here. And let's say, I'm not saying this is a great short opportunity, but let's say you intend to play this short. You want to play it short under the consolidation, right? So you short it when it breaks the consolidation, and you want to put your stop loss, let's say, above it, just like that. So this is just an example, just to show you how to apply some of the theory. So let's say that's your end. This is your entry. This is your stop loss, okay? And our goal is to assess, what's our target? What's the next support level? Because remember, we're shorting it. So like I said, the general rule is look to the left, right? And in this case, when you see something, we're on the daily chart here. If you're seeing the stock and there's nothing, absolutely nothing to the left, what you're going to want to do is go to the higher time frame. So we're going to go to the weekly chart now. Okay. So now all of a sudden, we actually have a little bit more clarity on where our next support level is. Like on the daily chart, when we looked at it, well, there was nothing to the left, right? We can keep scrolling for a long time and we might not get anywhere with it. But we go to the weekly chart, we can immediately see, what's to the left, right? So we're taking a short position here, right? And Facebook does look lower. We have the declining 20-day moving average, right? We have a huge drop. It does look lower. However, where's the next support? How much lower does it look? Well, looking at it, our next support level is right around here. You want to say this entire area, right? So you want to say this is our next support area, right? I don't want to say it's one line, but this general area, right? So let's kind of draw it maybe here. Okay, so this is our next support level. All right, well, let's see if the trade is actually worth it, right? So this is our next support, and this is our stop loss, this is our entry. So now we're going to do some calculations. We're going to see, okay, what's our stop? We're going to subtract our entry from the stop loss, see what our actual stop is, see what our reward is, and we're going to determine if the trade is actually worth it, right? So that's a really good example of how to figure out whether it's actually worth the risk of taking the trade. So this is our next support level, and if we look to the left again, our next support level is right here, right? So this is our first support level. Our next one, we're going to look to the left, is directly below, is right there. So that's a good way of figuring out where support is. We're going to, and when in doubt, when you don't see support or resistance to the left, like in this case, go to the higher time frame, go to the weekly chart. Or if you're on the 5-minute chart, go to the 15-minute chart, or go to the hourly or daily chart in order to analyze what the resistance or support is. Okay, so that's a great example. Another example here, let's see, if we're looking at this uptrend, right? We kind of talked about in the first resistance video how resistance and support is used during uptrends or downtrends where our previous resistance, right, becomes the new support, right? So let's look at an example here. We could I guess we could actually use this as an example right here, right? We have a consolidation right here. We have a rally consolidation. So this is our resistance, right? This level right here, right? Because we had it retested that resistance basically almost 3 times, and the third time it actually went through it. But notice how when we actually had a pullback, it pulled back, maybe not exactly to this resistance, right? But around in that area. So this is a great example of resistance, now becoming support on the pullback. And that's what we want to see. We want to see the pullback, actually pull back to the previous resistance, which was right here. So this is a great example, right? Let's look at another example here where, another example here where our resistance is actually right here, right? Oh, sorry for the text, guys, but our resistance is right there, and our pullback occurred to, we had the rally and it pulled back to the previous resistance, and now that is the new support. So this previous resistance became the new support for the stock. Okay, I hope that makes sense. And this relates to the first video where we talked about, resistance becoming support. So these are two pretty good examples. Well, I think actually this is even better example right here. We have a rally, then a pullback, right? Notice how the pullback, it pulled back to this previous support, this resistance area. So this was resistance, and now it became support here, right? This is now the new resistance, and this new resistance, notice how the stock pulled back to this resistance, now becoming support, right? And if this sounds a little confusing, go back to the first resistance video, and that's where I really talk about it more. It's a more of a theoretical approach, but it's definitely, I give a bit more detail. But the general idea is that the previous resistance level, right, like this previous resistance level becomes the new support when the stock actually pulls back. So it pulls back to the prior resistance, and that now becomes support, okay? So those are two good examples of that. Another example that I want to just show you here is this kind of relates more to the 200-day moving average, but this 200-day moving average right here is acting as support, right? We have the stock pulled back here, retested it, that's one. Then it retested here and rallied, that's two. And again, it retested actually here. So now this has been a proven support level. So this is a really good example of how you can use the 200-day moving average as support to your advantage, okay? And I guess we could talk about one more thing. Let's say all of a sudden we're looking at, let's say we're going to reverse back in time and we're here, right? Let's say this drop right here hasn't occurred yet, and we're here in time. If you're looking at this and thinking, okay, do I want to play it long? Well, either way, you're not going to play it long because we have a declining 20-day moving average. It's a downtrend, but let's say you decide to play it short and you want to short it here. Well, if you're gonna be looking, you're right here, you're gonna be looking directly to your left, which is these candles and then these candles, right? So right away, if you're trying to short it from here, we have support here and here and here, right? We have a support level here. We also have support down here. So, if you're looking at this and you're thinking, okay, do I want to play it short? Well, you got to ask yourself, is there a lot of support below? And in this case, there was a lot of support below. You had all these candles, then plus you had these candles, right? And then you had this low. So the answer is, yeah, there was a lot of support. And you would now consider that. You're like, okay, there's tons of support below. Do I really want to short it? Am I that confident that's actually going to go through the support? Okay. Let's look at another stock real quick. We can look at PLTR and kind of look at what's going on. In this case, if we're looking, let's say for example, we actually want to short this, right? Because with the 20-day moving average is above. If the 20-day moving average was to theoretically start to curl over price, we could actually probably look for a short position in theory, right? I'm not saying we should do that, but you can. Now, if I'm looking at this, right, I'm looking directly to my left. We have this entire support, right? Because remember, we look directly to the left. If we're here, we're going to look to the left. We have this entire support, right? Not only that, but we have this low, right? So we have two kind of support levels right in front of us, right? Let's say it actually breaks through the support, right? It ends up going lower. It actually breaks through this entire support level. Our next support is right there. So the question is, does it really have that much room to drop before it hits support? Right? And that's something that you're going to have to figure out. Like, does it have enough room? Like, if you put your stop loss here, entry here, well, it doesn't really make sense from a reward to risk standpoint because the next support level is directly below. So you would probably be a little more hesitant on actually taking this trade because of that, because support is right below. Because, and let's say it hits support. Well, the likelihood that it's just going to rip through the support level and continue lower is kind of low. It might go down to support and then bounce and stuff like that, maybe rally a bit off support. We want to have, let's say our support level is actually down here instead, then we would have ample enough room for the stock to drop before it's actually hitting that support level, okay? I hope that makes sense. This is a good example right here. We have a drop then this is a clear support level. You can see how much it's retesting and bouncing. So this is a support level. And as soon as it broke this support level, well, this is our short position, right? We short it right there as soon as it breaks this support, because it's kind of like a consolidation here, right? We probably put our stop loss around right here, right? And you could see that ended up really dropping. But if we're in this area, right, and we're looking at, like, let's say we're looking to short it here, maybe actually wouldn't have been the best position because we did have this support to consider, right? Because if we're looking at this, right, we have to look directly to the left at the next support level. The next support level is right here. Luckily, it ended up actually completely breaking through it, but still, that's how we're going to be looking at support resistance. Look directly to your left and look at the next support or resistance level, okay? Let's see if there's any other examples that I can make from here. Not really. We can move on to the next stock. We'll probably do one or two more here, right? I think this is, okay, this is interesting. Well, we can kind of go through this right here. If we're looking at, right, let's say we're looking at this point right here, and we're looking to play long, right? Well, if we're looking to play long, our next support level is going to be right there, right? Because if we're buying it down here, let's say it's a buy setup, we're buying it here, our next support level is the previous highs, right? So that's our previous resistance. I'm sorry, I keep saying support. This the resistance level. So the previous, we're going to look to the previous resistance level, which is right here. That's going to be our target number one, right? After that, we're going to look at the next resistance, which is basically, you know, we're going to look to the left. It's this next high. So this is our next resistance level. And as you can see, the stock actually went up to that resistance level and ended up dropping down. Okay, so I hope this is starting to make sense, and we could you're beginning to understand how we could apply support and resistance, right? So if we're playing it long from here, we're going to look to the left. This is our first resistance level. The next one, we're going to look even more to the left. Okay, this is our next resistance level. And it ended up rallying straight to that resistance and dropping. So that would have been a perfect target. Okay, so in general, guys, I'm not going to go through all of these. You guys get the idea. We're going to be always look to the left. Always look to the left, and to specifically the immediate left to check for support and resistance. And you're going to be using it as targets, right? If there's a lot of support below and you're shorting it, maybe reconsider the trade, right? You don't want there to be tons of support below because the likelihood of that trade actually working is a lot lower. Just like if you're playing long, right? You don't want there to be tons of resistance above because it's going to be, you know, the likelihood of the trade actually working out in your favor is a lot lower. Okay, because there's tons of resistance above. Resistance is going to stop the stock. It's going to stand in the way of the stock really continuing higher, right? And that's why I personally like trades that are going into all-time highs, right? So let's say we have a stock that, you know, it pulled back, right? I'll kind of paint it out like this. Okay, boom. Let's say we have a rally, then a pullback, and then another rally, and it's basing at resistance at the all-time highs. That is extremely bullish, right? So I'm going to actually write that. This is going to be kind of another quick little lesson here. A consolidate base at the all-time highs is a very bullish quality, okay? And similarly, a base at the all-time lows is a very bearish quality. Okay, so let's say, like I said, this is here. I'll even write it. I'll even write it here. Boom. Right. So let's say we have a rally, then a pullback, and then we have another rally, and it's basing at the all-time highs. That is very bullish, and we like that. We want to see that. And the reason it's very alluring is that let's say it actually ends up breaking out. Let's say it breaks out. Well, there is no resistance to the left, meaning this has unlimited room to go higher. Excuse me. And that's the great thing. There is no resistance to stop the stock from actually continuing higher, right? Since there's no resistance, the stock could easily continue higher as much as it wants. Okay? Just like it worked the same way if it was the opposite. If it was a base at the all-time low and it started to break down under the base, there's no support below. So it, in theory, has unlimited room to continue lower, right? And that's a great quality, because since there's no support below, I mean, on the one hand, we can't really pick targets all that well, but there's no support to, stop it from going lower, which is great if we're shorting it. Okay? Hope this all makes sense. I'm going to try to find maybe an example here. We could find an example here. Let me look. Maybe, let's see. Let's look at this one. No. Okay, this is actually a fine example. We could look at Hood, for example. Okay. Let's say we were shorting Hood under this base. Just as an example. I'm not saying I would do this, but let's say that's what you were going to do, right? Well, there's no support at all under this base. There's nothing to the left of it. So this, in theory, there's no support to base our targets off of, but there's no support that's going to stop it from continuing lower. So this can, in theory, go lower all the way to zero if it wanted to. Obviously, it's Robinhood. It's probably not going to do that, but you guys get my point. There's no support stopping the stock from dropping, which is great if we're shorting it. Or just like the opposite, if we're playing long and there's no, and we're into all-time highs and there's no resistance above, well, there's no resistance that's going to stop the stock from continuing higher. So the point is that a base at the all-time highs or the all-time lows is a very bullish and bearish quality. Meaning, if it's a base at the all-time highs, it's very bullish. If it's a base at the all-time lows, it's very bearish, right? And we want a breakout into the all-time highs because there's no resistance to the left stopping it from going lower. And similarly, we want to short under the all-time lows, especially if there's a consolidation at the all-time lows. We want to short under that consolidation, right? Because there's no support stopping it from continuing lower. All right. And let me know if you guys have any questions about that. And hope this helps. We've kind of took some of the theory we already learned and put it into more practical information. Okay. Let me know if you have any questions. Thank you. What's going on, guys? Hope you're having a great day. And today we're going to be talking about another tool that I use on my charts. Okay. We already talked about the 20-day moving average. We talked about the 200-day moving average, and we talked about how to read candlesticks. But I also use another very important tool, and that's called volume, okay? And a lot of people kind of overhype the utility of volume. They say that, they kind of come to these random conclusions about what's going on with the stock or crypto based on volume. Or they'll say, because we see a volume spike, this, and this is going to happen. And most of what you're going to hear about volume out there is complete nonsense, okay? But I'm going to give you guys the actual way you could use volume to your advantage and the situations where volume is actually pretty useful, okay? And by the way, guys, before I start the class, I just want to tell you a lot of what I'm teaching doesn't only apply to volume. This is stuff I've learned through experience, okay? So you might catch me throughout this class kind of citing specific instances of different things that have happened to me with volume, and it's very experience based. Okay, this isn't stuff that I'm just finding on Google. Okay, this is stuff that I've actually gone through taking on thousands of trades and through my years of experience. So how can volume be a powerful tool? And there's really only a couple ways you could use volume. And what is volume in the first place? It shows you how much a stock or a crypto is being bought or sold. It's showing you how many shares are being bought or sold, okay? And volume is one of the primary ways of predicting price reversals, okay? And using volume will greatly increase the accuracy of picking tops and bottoms with precision, okay? There's this really interesting idea of finding tops and finding bottoms, right? Where you're buying at the absolute lows or you're shorting at the absolute highs. A lot of people want to do that. And if you're one of those traders where you just have affinity towards finding those type of reversal plays, you're going to be using volume and looking at volume a lot. All right. And another thing that another way you could use volume is that it can indicate when a move, usually it's a rally or a drop in price, when it's beginning, ending, or continuing. Okay. And we're going to get into that. So first, I want to kind of classify different, I guess you could say different versions of volume. I guess that's the best way to put it. So the first classification is amateur buy volume, okay? Where let's say we have a multi-move or a multi-bar move towards the upside where we have 1, 2, 3, 4, 5. We have 5 green bars in a row, and we start to get a spike in volume towards the end of the move, right? Towards like after you see the 5 green bars in a row and you get a huge spike in volume. That suggests that that is the end of that move and a reversal might take place, okay? And you can think of this increase and this spike in volume, and you could think of it as the last group of buyers who have finally bought the stock or crypto, and that stock or crypto is running out of demand, right? You could see that the green candlesticks. And the reason we call it amateur volume, specifically amateur buy volume, is because what do the amateurs want to do? What do the novice traders want to do, right? They hate missing out on moves. When they see a stock or a crypto go up 1, 2, 3, 4 green bars in a row, right? What do? They're like, oh my God, I don't want to miss out on this rally. This stock or crypto is going to continue higher. I don't want to miss out. And what do? They start buying at the highs, right? That's what amateurs and people who really don't do this professionally, that's what they do. They buy at the highs and they sell at the lows, losing money. So you could think of it, these candlesticks, this is amateur volume. These are the amateur traders who are buying it at the highs with the fear that they're going to miss out on this move. But they already missed out on the move, right? The professionals are buying it down here before the move, right? The amateurs are the ones that are buying it at the highs, right? So you could think of this as the last group of buyers. They're finally getting into the stock. And this is really also effective when this rally is right into resistance. If this rally is directly into a resistance level, it's much more potent, right? If you see this amateur buy volume, it suggests that we're probably, going to see a reversal here. And like I said, think of it as novice or beginner traders finally buying their position. They saw the move already go up without them. They're finally buying the position up here when when the professionals are actually selling it up here, right? Someone is selling their shares or their coins, right, their crypto coins to these amateurs, and those are the professionals. The professionals are buying it down here, and they're selling their shares or their coins to the amateurs up here. And you could see that that's when we get the sharp reversal lower, right? So let's continue. We also have amateur sell volume, where let's say we have a multi-red bar move lower, and we start to get that amateur volume. You could this spike in volume at the end of the move suggests that a reversal might take place, and you could think of this as the last group of sellers who have finally sold their stock or their crypto, and the stock is running out of supply, or the crypto is running out of supply, okay? And it's very effective if this is actually kind of dropping into support, and we also get that amateur buy volume with multi red bars lower, okay? And think of it as novice or beginner traders. They're finally selling it, right? These beginner traders, these amateurs, they were down on their positions here, right? They were losing money here, but then they see the stock or the crypto continue going lower, and their losses are increasing. They're increasing until eventually they can't stomach, right, that huge loss, and they're like, you know what, I'm going to exit the position. And as soon as they're exiting the position, right, they're selling their shares to the professionals who are buying it down here. Okay, hopefully that makes sense, and that's why we get that sharp reversal higher. Okay, so quick summary, guys. If you have several green bars in a row or several red bars in a row, and you get a huge volume spike towards the end of that huge move higher, probably means that you're going to get a reversal, right? And these are the amateurs who are buying it at the top, right? Because they have the fear of missing out on the move. But remember, we're trying to be professional traders. We're the ones who are either shorting it up here or selling our positions that we bought down here. Okay, same thing with amateur sell volume. Maybe the people who, right, they're taking big losses on their position. It's dropping and dropping and dropping. They can't stomach their losses. They end up selling it down here, and those are the last, group of sellers, and then we get a pop higher. Okay. So another version of volume, it's called igniting, or classification of volume, it's called igniting volume, right? And we talked about an igniting wide range bar, an igniting wide range candlestick. We already talked about that. Okay, so what you guys want to do is couple the wide range igniting candlestick with igniting volume. Okay, so this volume is igniting a brand new move or direction. The professionals, they don't enter a stock at the end of the move. They enter at the beginning. We talked about this. The professionals, they're not buying it up here. They're exiting here. And if anything, they're shorting it up here. They're not selling it down here, right? If anything, they're buying it down here, okay? And so it makes sense, right? The professionals, they're entering at the beginning. And this is also a very potent reversal signal where you're often going to see amateur volume, right, followed by igniting volume, right? So this is amateur volume right here, where the sellers are trying to get out of their position, and the professionals start buying it here, and this ignites the move higher, the reversal higher. There's also something called continuation volume, and this really only applies to a base, right? So we already learned about the base breakout or the base breakdown, okay? So this is something that you want to combine with the base breakout, where let's say you have a rally higher, right? You have pretty high volume during the rally, and then you start to get a base, right? You start to get a base. What you want to see during that base is very low volume. It indicates that there's not that much selling pressure. So when the stock does have a breakout and that igniting volume, it's more likely to succeed, right? So you don't want to see high volume during a base. You want to see very low volume during a base, because that is continuation volume. And then when the stock breaks out over the highs of the base, that's when you want to see igniting volume. And this igniting volume, it sparks a new move higher after you haven't really had any volume or any buying and selling at all during the base. Okay, hopefully that makes sense. So if you have a base, you want to have low volume. When you have that breakout, you want it to have igniting volume. Okay. We already talked about the shakeout bar, but let's kind of talk about it again. Why not? So it happens when a stock attempts to break down from a bullish base on large volume and fails to break down, right? So you can combine volume with the shakeout, where you have a base with low volume. All of a sudden, you get that shakeout bar, right? This bottoming tail. It triggers everyone's stop losses. We get that drop, right? We have large volume during the shakeout, and then it comes right back to the highs to finish here. And then we continue basing, and then we have the real breakout where we have huge igniting volume, okay? Why is it called a shakeout? Most people who are in their long positions, who are expecting the rally to continue higher, they're placing their stop losses under the base, right? When the stock attempts to break down, the stop losses are hit, propelling the stock lower, right? All those sell orders, those stop losses are hit. It causes an influx of selling. The stock or crypto drops. And if the stock is still able to get bought and return all the way back up to the highs, then there's clear confirmation that we're going to continue higher. We already talked about this, guys, but this is kind of a reminder. So it's okay to see large volume during a shakeout before we have the igniting volume during the actual breakout. Let's also talk about potential reversals when we're looking at a base. So this is something I can guarantee you're not going to learn anywhere else. I would highly doubt there's any other course in existence that teaches this very topic, because this is something I personally learned. This is something that over the years I saw this so often that it's almost become just like its own trading strategy almost, right? So if you have a base, right, we have a rally, we have a base, we're setting up for a base breakout, right? You're looking at it, you want to play it as a breakout. And you have a sudden volume spike that does not lead to a breakout. This can be indicative that a stock or the crypto will reverse in price. And this usually applies more to intraday trading, meaning the smaller time frames, right? So we want to see igniting volume during the breakout, right? When we actually make the move higher, we want igniting volume. But let's say we all of a sudden get igniting volume, we get that volume, huge volume spike, and you're seeing, hey, this stock or this crypto, it's not breaking out. What's going on here? When you see something like that, you should be very cautious, because it usually means that we're going to actually end up getting a reversal. Because, right, if this is a volume spike, if this is igniting volume, these are people, buyers, that are trying to get in and buy the stock or crypto and propel it higher, right? And if this is buying pressure, it's a green volume spike, and it doesn't go higher, well, why, right? Like, there has to be something going on. And just be cautious. It usually ends up leading to a reversal. So if you're in a position, right, and all of a sudden you see a huge volume spike and the stock isn't going in your favor, it probably means it's about to go against you. Okay, so keep that in mind. So let's now talk about breakout and breakdown failures. If you have, let's say, a base breakout, right? You have a rally and you're basing, you're trying to go for the breakout. Let's say you get the breakout, right? It hits your entry, you're in the position, it breaks out, okay? And you get that igniting volume. But let's say this igniting volume doesn't lead to a continuation move higher, and in fact, you end up failing and you end up getting a red bar that's going lower, right? With a huge volume spike. It basically confirms that this is a failed breakout. If you get a rally and then a sudden drop, right? Like, let's say you're in it, it goes up and then it drops against you on huge volume, then you should maybe immediately exit that position and maybe even play it short, okay? It's considered a failed breakout, and it suggests that the prices are going to actually continue lower. So just understand that if you're in a position and it breaks out on igniting volume, but then immediately starts to drop and come back in, also on huge volume, it suggests that that's a breakout failure and get out of the position, okay? So a lot of the times you can pinpoint failures by just looking at volume. And let's say all of a sudden, we have a huge volume spike, and then it starts going against you on huge volume. You can maybe exit before it hits your stop loss, right? Because then you're like, oh, this is a breakout failure, let me get out, okay? So let's look at some examples here on how we could use volume, right? You could see that we dropped right into the 200-day moving average. We know that acts as a floor, acts as support for our stock or crypto. We drop, oh, boom, we got a volume spike right here. This led to a reversal, right? All of a sudden here, check this out. This volume spike correlated with this reversal. We drop, right? We don't really have any volume reversal here, okay? It's not going to happen every time. Then we drop, we rally again on large volume. We start to get a big volume spike, right? We drop. It's not too prevalent here. I think this is the best example because we actually have a multi-bar move lower. Like here, it's It's green bar, red bar. We have a bunch of doji candles. There's not that much momentum here. But here we're getting, huge red bars in a row. And you could see that. You could see the clear amateur volume and the clear igniting or professional volume, right? We drop, right? We're getting that big amateur volume. All of the people, they're finally selling their position after they took a huge loss. And then boom, we have an igniting move higher. We have ignite on green volume, and boom, we continue higher. So you can see how this is really, it's really, it comes in handy when you're picking reversals. Let's look at another example. We have a large move lower, right? Aside from this green bar, this is all straight red bars in a row. We drop hard, huge volume spike, we reverse, right? Right here, huge volume spike, we end up dropping. And I think it's really prevalent here, right? We have a huge 1, 2, 3, 4, 5 red bars in a row. We also have a bottoming tail here, which suggests that this was, this was selling off. At some point, we were selling off to down here before the buyers started coming in, right? So we made a huge drop on huge volume, right? So notice that whenever you're seeing huge volume, right, you could see this is much greater than any other volume that we've had here. Drops, huge volume, that's when we get the reversal, right? And you could see this red volume, that's amateur volume, and then you could see the green volume, that's sparking the new move higher. Those are the professionals buying down here. Let's look at another example. I mean, this is perfect. We have a huge move lower, we have a double bottom, we have a bottoming tail. On huge volume, we get the reversal. So we didn't really get amateur buy volume here, or amateur volume. We kind of did maybe with this candle, but we get a lot of igniting volume that ignites the new move higher. Same thing here. We drop, huge spike in volume, and ignites this move higher. Okay. So let's go over the example where we talked about continuation volume and igniting volume. Notice we have a rising 20-day moving average. We have a really tight base, beautiful base that's based right into the 20-day moving average as it's rising. We get that breakout. Notice how during this base, look how low the volume is. It's beautiful. And then boom, we break out on huge volume and we continue higher. Sparks this new move higher. Beautiful. Let's look at another example. Let's not only talk about volume. There's a bunch of stuff to talk about here. Rising 20-day moving average, that's underpriced. Check mark. Right here, we have huge volume igniting this move, right? We end up getting a pullback and we get a buy setup, right? We get a buy setup right here. It's right at the 20-day moving average. Really nice buy setup, right? We have 1, 2, 3 red bars in a row. Kind of a deep retracement, but it's right to the 20-day moving average. Really nice entry bar. We rally to resistance, right? Because the previous highs is resistance. We start to base at resistance. And where do we base into? We base right into the 20-day moving average, the rising 20-day moving average. Beautiful. With continuation volume, really low volume. And then we get that huge spike in volume during the breakout, right? We continue higher and then we get a buy setup right here, right? Pullback pattern, beautiful, right to the 20-day moving average, doji candle, really small entry bar, really nice risk, reward to risk, rally. Everything is beautiful about this chart. Let's look at another example here. This is actually a gap up. So this happens with stocks. We'll talk about that later. But you could see, right, we're kind of down here. We're kind of just sideways down here. We get a gap up and on huge volume. And this is professional volume, right? These are the professionals starting the new move higher. It gaps right to the 200-day moving average and ignited a new move higher. Another example, we get a drop. It ignites a new move lower. You could see huge volume spike. Okay, so something that I really want to emphasize here, guys, is, like I said, volume is really useful for reversals, especially when it's when you get a huge move. Like, for example, you get a huge drop, then a big volume spike usually means we're going up, right? Huge drop, volume spike usually means we're going up. Same thing right here. I mean, this is a perfect example. Huge drop. I mean, 1, 2, 3, 4, 5 red bars in a row. Nice amateur volume, and then boom, we get a igniting volume. So notice how sharp increases in volume during major sell-offs or rallies lead to sharp reversals as well. Okay, and if you guys have noticed, especially looking at this chart, right, you're starting to notice how we're putting everything together in this course. We're putting the 20-day moving average, right? We're combining it with the strategies we've learned. We're combining it with volume. We're combining it with the 200-day moving average. We're combining it with reward to risk, okay? So towards the end of the course, I'm going to try to give you guys more practical kind of tests or practical quizzes on this stuff. But yeah, volume, very, very useful, guys. Hope you guys kind of understand the theory behind amateur volume and igniting volume. This is important stuff here, but just understand that it's mostly used for reversals. And if you have a base, you want to see a base on very low volume. Okay, guys? Hopefully that makes sense. Have a good day, guys. This was a great class. See ya.
Now that you've learned everything that you need to know about reading price action, let's use that information and learn how to identify high quality setups in the markets. And that's exactly what we're going to be talking about in this next chapter. I'm going to teach you every single trading strategy that I use on a day-to-day basis. So let's not waste any time. Let's hop right into this chapter.
What is going on, guys? Hope you're having a great day. We have finally reached the strategies section of the course where I'm actually going to be teaching you different trading setups that you can begin spotting on your charts and hopefully taking advantage of. Okay, so this is finally the most exciting part of the course. But before we go into some of the presentations that I have prepared for you guys, I want to talk about a very important concept, and this is going to kind of preface the other strategies and the other presentations that I have prepared for you guys. And that concept is price correction. Okay, so I'm going to draw a diagram here for you guys. So what we have to understand is that with price action, whether it's for a stock or a crypto or Forex, it really applies to any financial instrument on the market. What we have to understand is that price always corrects itself in some way, right? Prices can't just go infinitely higher. At some point, we are going to have some sort of price correction. And that price correction could happen in two different ways. It could either happen through a pullback or a retracement, or it can happen through a consolidation or a base. So let's first talk about the pullback, right? So let's say we have a really bullish rally, right? We're in a very bullish stock. There's a lot of buying. There's a lot of, strong momentum. After a really strong rally, right? At some point we have to see some sort of retracement or some sort of base, some sort of price correction, right? So price can correct itself in the first way through a pullback, where when a pullback happens, right, we get a minor drop, where perhaps the reason of this is there's a lot of buyers who are buying it down here or buying it over here, and they're enjoying their profits as the stock or crypto is rising, and at this point they want to start taking profits, right? So all those buyers start taking profits, which leads to a drop, or in other words, a price correction. Or perhaps there's a ton of people up here who are skeptical that the stock or crypto is going to continue higher. So what they do is they short it up here, thinking they're going to make money, if this thing drops in price. Okay? So that's one way we could have a price correction. And of course, after the correction, right, ideally, if it's a really bullish uptrend, right, if there's a lot of buying pressure, a lot of buying momentum, we're inevitably going to continue higher, right? So our goal is to buy it where? Our goal is to buy it right down here, right? If we missed the opportunity all the way down here, our goal is to buy it during the correction, right? Why? Like, our goal isn't to buy it at the highs, it's to buy it on the pullback, right? Because after you would assume that price has corrected itself, we're ready to continue higher again. This, my friends, is called a buy setup. Okay? This is a buy setup. So that is one of the strategies that we're going to be learning, right? Buying, you could think of it as buying the dip I know that's a really popular phrase, but this is what that is. And that dip, like I mentioned, is a price correction. So we are buying this price correction. So that's one way price can correct. Another way price corrects is, let's say we have the same rally, we have a huge rally. We can correct through time, or in other words, through a consolidation or a base, right? Where we actually just stay at the highs of this rally, right? Maybe at this point, there aren't enough buyers to, propel this stock or crypto higher. And there's also not enough sellers to, cause it to pull back. So instead, we just sort of base, we just sort of stay at in this price range, right? Where we don't have enough buyers to bring it higher, but we also don't have enough sellers to bring it down. So we end up just consolidating or staying near the top of this base, right? Before we inevitably continue higher. And our goal, right? Our goal is to buy it as soon as it breaks out of that base, right? After, as it's consolidating, right when the price correction has finished, our goal is to buy it at this point and enjoy the move higher. And this strategy is called a breakout. Okay? And specifically, a base breakout. Okay? So this is kind of the fundamental anatomy of the two strategies that we're going to be talking about first. We're going to be talking about the breakout first, and then we're going to be talking about the buy setup. But something that's important to note from listening to everything I'm telling you guys in this presentation is this is how price corrects itself, right? And based on how price corrects itself, we could find opportunities, okay? We can find opportunities to get into the stock and enjoy the next move higher, right? Because to be honest, guys, you're not always going to be able to buy it down here or buy it down here, right? Sometimes you're going to be late to the party, but you have to identify the points where price correction has completed and we're ready to continue higher, where price correction has completed and we're ready to buy the breakout and enjoy the next move higher. Okay? Hope this makes sense, guys. And in the next class, we're going to be specifically talking about the base breakout. Okay? So make sure you understand this concept and understand that price cannot go infinitely higher. It cannot go infinitely lower. At some point, there needs to be some sort of correction. Okay? And I'll see you guys in the next class, guys. We're going to be talking about the base breakout. Thanks. What is going on, guys? Hope you're having a great day. Today, we are going to be talking about the base breakout. And hopefully you guys understand what we talked about in the last class and how price corrects itself in two ways, either through a pullback or through a base. Okay, and today we are going to be talking about the base breakout or the base breakdown setup. Okay, so let's get right into it. So the base breakout, what is it? This is one of the most potent and fundamental trading strategies that exist. In fact, this is my favorite trading strategy that exists. I make money off this setup every single day, okay? Because I see it all the time. It's a very, well-known setup. And if you know how to play this setup correctly, I can promise you, you are going to make a lot of money trading, either whether it's stocks or crypto or Forex, okay? It's that powerful of a setup. And like we talked about, a base or a consolidation is a period of time when a stock or a crypto is trading in a particular price range. It's not moving out, it's not moving above or below that price range, right? It's sort of staying at the same price level. And our goal as traders is to take advantage when price breaks out or breaks down out of that range, right? We're timing our entry when price breaks out or breaks down. This works on any financial instrument, including stocks, crypto, and Forex. Okay, this also works on any single time frame, and it's a very good high reward to risk setup. That's one of my favorite parts about it. So let's understand the anatomy of the base breakout. And we kind of looked at this before, but let's try to get a deeper understanding. So like we talked about, price corrects itself either through a pullback or through a base. Okay, so in this case, we're talking about the base. So after a large rally higher, we have a base where price is sort of, it's not trading above or below this price range. We're just sort of chilling at the highs of this rally, right? And our goal as traders is to find the moment that price breaks out of this range and continues higher. So we want our timer entry over here, right here. Okay? And we have to understand that in a bullish uptrend, right, if there's a lot of buying pressure in that stock or crypto, after a large move higher, oftentimes it's going to correct itself through a base. So it's really important that you guys can identify when this is happening so you could take advantage of it and take advantage of this point right here so you can enjoy the next move higher and hopefully make a lot of money. Okay? And I believe that's all. So just remember, guys, during this process, price is correcting itself. And as soon as it's done with the correction, we're ready to continue higher, and this is where we're buying it. Okay? So this is kind of a little graphical representation of this. We have a rally, and then we have a bunch of candlesticks that are trading in, at the highs of this rally. We're trading in this price range. And just understand that at the top of the base, right, at the highs of the base, that is an area of resistance, right? Because the candlesticks are sort of respecting that high of the base. So it creates a resistance. And the same thing happens at the lows, right? The candlesticks are respecting the lows of the base, right? And that's going to be support. So if you ever see a base like this, just understand that over the highs of the base, we have an area of resistance there. And under the lows of the base, we have an area of support there, okay? So let's talk about the actual base breakout setup and our entry and stop loss, okay? So we have the rally, we begin to consolidate, right? We are going to place our entry over the highs of the base, and we are going to be placing our stop loss under the lows of the base, right? So let's say you have a base like this, find the absolute highs, right? In this case, it'd be over this candle, and place your entry over the highs of that base. And my recommendation is, let's say the highs of the base is, let's say it's $6. You want to place your entry at about 602, 603. You want to give it 2 or 3 cents room, okay? So you give the stock or crypto the actual room to break out and truly break out of this resistance, okay? And the reason our entry is above the highs of the base is because that's when price is breaking that resistance, right? We're timing our entry with the break of this resistance, all right? And for our stop loss, we're placing our stop loss under the lows of the base because that's where we have an area of support. So this is super easy, guys. If you see a base and you wanna play it, you wanna get into it, entry is over the highs. Find the absolute highest point of the base and place your entry above that high. Place your stop loss under the absolute low of the base. Okay, that's your entry and your stop loss. Pretty easy stuff. Now, let's talk about the 20-day moving average requirement. We already reviewed the 20-day moving average and how important it is. And we know that we want to see the 20-day moving average either trending higher or trending lower, right? If we're bullish, we're in an uptrend, we want to see the moving average trending higher, ideally at a 45-degree angle, and under price, okay? So that's what we need here. For a base breakout, we want the 20-day moving average to be trending higher and under price. That is a requirement. You need to have that if you want to play the base breakout. It is the most crucial requirement, okay? And the reason we want it is because oftentimes during a really bullish uptrend, stocks and crypto, they tend to base into the 20-day moving average. They tend to just, consolidate right into it. And as soon as it's at or near the 20-day moving average, that's when it ends up breaking out. Okay, this is just something that happens. Okay, and we're going to show you guys examples of it soon. So something to understand is that at this point right here, right, let's say we're right here, we are extended from the 20-day moving average, right? And by extended, we learned about this prior, is that we know that extension means distance. There's distance between the 20-day moving average and price, meaning price is kind of overbought, right? It's a little extended. So what do? We need to have a price correction. So we end up basing. And as we're basing into the 20-day moving average, price is correcting itself and it's getting ready to make the next move higher. So our goal is to time your entry when price has based into the 20-day moving average, or we just want at least the 20-day moving average to be near price. Okay, we don't want to be buying it here because right here, there's still some distance between the 20-day moving average and price. There's still some extension. We want to be buying when it's at or near the 20-day moving average when there's no extension. Okay, when there's we're not overbought at all. Okay. Hopefully that makes sense. So overarching theme here, guys, is for a breakout, make sure the moving average is trending and underpriced, and you want to be buying it at or near the 20-day moving average. Okay? Let's continue here. And this is something that I oftentimes see. What I see often is a rally higher, then we begin to base. We begin to consolidate. As soon as we hit the 20-day moving average, we have that breakout. And our price is going to be at this resistance level, right? It's over the base. This line is directly over the base. This is our entry point. So we would be entering as this green bar is being formed. We would enter right there, and then we would enjoy these profits going higher. Now, oftentimes what I see is after this primary breakout, after we break out of this resistance and we continue higher, I often see us having another sort of price correction, but this time it happens through a pullback. So after this rally, we actually pull back, okay? And we form a buy setup, or you could call it a secondary breakout. We're gonna be learning about the buy setup later, but oftentimes after this initial breakout, we pull back, we form the buy setup, and then we continue higher. And you can think of this as a pullback pattern. Right? Like I said, we're going to be learning about that in the next class. But what I really want to emphasize here is oftentimes this line right here, this entry point, this is serving as resistance, right? We're buying it when it breaks the resistance of the base over the highs of the base. But this prior resistance level, right, is now turning into support for the stock or crypto, where we actually pull back to this prior resistance, which is now support. So during this point, it was acting as this resistance level was acting like a ceiling. As soon as we broke out of that ceiling, it's now turning into support. And we retrace right back to that support level before we continue higher. Okay. Now, this doesn't always happen, but I think it's something to show you guys. I think it's important. Here's an example of that. Okay. Where we have a large rally higher, right? Look at this. We have a rising 20-day moving average. We have a huge rally higher, okay? At this point right here, there's significant extension between price and the 20-day moving average. Price needs to correct itself in some way. So first, we have a pullback, and it sets up as a pullback pattern or a buy setup, right? That triggers higher, that goes higher. But there still needs to be some sort of correction, right? This was a huge move. It needs additional correction. So what do? We base, and we stay in this price range, and we stay in this price range until eventually the 20-day moving average, this blue line, starts to curl under price. It starts to trend higher, and that's when we get the base breakout right here, where this red line is the entry point, this red line is the resistance. We break out of that resistance and we enter right here. We rally higher before we have that pullback. And this prior resistance, which was our prior entry point for this primary breakout, it now becomes a support for this pullback. Okay, hopefully that makes sense, guys. All right. Okay, very good. Next, excuse me. We're going to be understanding the base breakdown, which, guys, the base breakdown is the absolute opposite of the base breakout. It's the same exact thing, except it's the opposite. We're going to be taking advantage of shorting it. Okay, but nevertheless, I'll go over it. As we know, price corrects itself in two ways, either a pullback or a retracement or a base. So we have a drop, right? Let's say this is a downtrend, right? It's clearly a downtrend. We have a lot of bearish momentum. There's a lot of selling pressure. We have a drop and we consolidate at the lows, meaning, right, we have a drop. It wants to continue lower, but it needs to correct itself first. So it corrects itself through the base. We're chilling at the bottom of this drop before right here we have that breakdown. We short it. We have a nice move lower, right? We short it right here once it's breaking below this base. That's why it's a breakdown, right? We have a drop. And then we start to base again at the lows of this rally, right? And we have another breakdown here where we're trying to enter when price is breaking down out of this bearish consolidation. Okay, so like I said, guys, our goal is to catch the moment price breaks down and enjoy the next move lower, and we're shorting it. Okay, and we have to understand that in a bearish downtrend, whenever we have a downtrend, price tends to base after a large drop. That's just what happens. Okay, that's the way price tends to correct itself. It tends to correct itself through a base at the lows. So the same thing here. After we have a drop and we have this consolidation, we have these candles trading in this price range. At the bottom of the consolidation, we have an area of support. And at the top of the consolidation, over the highs of the base, we have an area of resistance. The same exact thing as we discussed before, except the opposite. So what's the entry? It's the same exact thing, except the opposite. Our entry is going to be under the lows of the base, and our stop loss is going to be over the highs of the base, right? Because we are entering when price is breaking that level of support. That's when we're timing our entry. And we are placing our stop loss over the highs of the base because that's where the area of resistance is. Okay? So yeah, to emphasize, we're trying to enter when it's breaking that support. And that's where we enter and we enjoy this move lower. Okay, so entry under the lows of the base, stop loss over the highs of the base when we have a breakdown. Okay, very good. Let's continue. So just like the breakout, we have a very strict 20-day moving average requirement. Like I said before, we want the 20-day moving average to be trending lower and over price when we're in a downtrend or when we're bearish, right? We want it to be trending lower and over price. So that's a requirement. And oftentimes, stocks and crypto, they base into a declining 20-day moving average. This is the way they correct themselves. Because as of right here, at this point here, price is extended from the 20-day moving average. And by basing into the 20-day moving average, we have that price correction and we're finally ready to short it as soon as it breaks under that base. And we want to time our entry when price has already based into the 20-day moving average. Okay, it's the same exact idea, guys. And same exact idea here as well. We have a drop, we base, right? Our entry, this is our entry point, which is the area of support. So we're timing our entry when it breaks this area of support, right? This is the primary breakdown that we're playing. We're at the 20-day moving average. We drop, right? Because remember, we shorted it here below the base. This is the primary breakdown. And oftentimes we have a retracement. And this retracement goes back to the declining 20-day moving average. And also it goes to the initial area of support, right? Our entry that's now becoming resistance for this stock or crypto. Okay, and this is our first retracement to the 20. This previous area of support has now become resistance. Okay, this doesn't always occur, but I thought it was important to share it with you guys. And we're going to be talking about reward to risk in the next class. What is going on, guys? We're going to be continuing the presentation exactly where we left off. And we're going to be talking about reward to risk. And this is one of my favorite parts about the base breakout is the reward to risk aspect of it. And my biggest recommendation, guys, is after you watch this class and later on in the course, after you watch my risk management and share sizing course, please come back to this section of the course after you understand the risk management, after you understand share sizing. And I think this whole section of the breakout is going to make a lot more sense. But nevertheless, I'm going to introduce this concept to you guys right now. But just keep in mind, you may want to come back to this part of the video in the future. So my question for you guys is, out of these two setups, which one is better in terms of reward to risk? Okay. Is it number one or number two? Right? And pause the video, take a second to think about it. Which one do I like better from a reward to risk standpoint? Which one has a lot higher potential to be lucrative, right? Which one has the higher potential to make us a ton of money? That's what we're here to do. We're here to make money. So if you guys have thought about it and you guys selected number one, this one right here, you would be correct. Let's talk about it. So over the base, we have our entry point, right? We always place our entry over the base. So for both of these setups, our entry is at $3, right? Over the base is at $3. Over this base, we have $3, right? But let's say our stop loss, right, is supposed to be under the base. In this situation, it's at 290, right? It's directly under. We have 290 as the price of our stop loss. However, in this situation, the base, you could see it's a little bit of a larger base. Our stop loss is under it, but it's at $2.70, right? So this one's at 290, this one's at 270, okay? So we have the same entries, but different stop loss prices, okay? So what is the size of our stop? Well, the size of our stop, all we have to do is subtract the stop loss price from the entry price, right? So $3 minus 290 is 10 cents. The size of our stop is 10 cents. So in other words, if we enter this setup, this breakout at $3, if our trade drops by 10 cents and hits 290, we are out of the trade, right? That is our risk. If it drops 10 cents from our entry, we are out of the trade. Now in this case, our entry is at $3, our stop loss is at 270. $3 minus 270, that's 30 cents, 30 cent stop size. Meaning if we get in at $3, that's our entry point, and it drops 30 cents, right, to 270, the bottom of the base where we have support, that's when we exit the trade. Okay? So hopefully that makes sense. Stop size 10 cents here, stop size 30 cents here. If we are risking $100 on both of these setups, meaning $100 is the maximum amount that we could lose for this trade, right? $100, like we can't lose more than $100, right? What are we gonna do? We have to share size accordingly, right? So if we're risking $100 with a 10 cent stop, right? Meaning if we get in at $3 and it drops 10 cents to 290, if it hits 290, we're out of the position. How many shares do you have to buy to ensure that if this drops by 10 cents and hits the stop loss price, we only lose $100? And I'll make it easy for you guys. The formula is take your risk, your dollar amount risk, which is $100, divided by the size of your stop, which is 10 cents. So 1,000 shares. Meaning we could buy 1,000 shares at $3, and if it drops 10 cents to our stop loss price at 290, we will lose $100, which is the maximum amount we are willing to risk. In this scenario, we're still risking $100. The risk is the absolute same. We're risking the exact same amount in both of these setups. However, in this case, we have a 30 cent stop, right? Because our stop loss is under the base at 270. So if we're risking $100 per trade with a 30 cent stop, well, the risk unit, $100, divided by the size of your stop size is 30 cents. 100 divided by 0.3 is 333 shares. Meaning, if you get in at $3, and if this drops 30 cents and you bought 333 shares and it drops 30 cents, you will lose the maximum amount you're willing to lose, the $100. So, looking at what I've presented you right now, you must have an immediate conclusion. And that immediate conclusion is the tighter the base, meaning the smaller the base, right? That you could see how this one is all sloppy. It's all over the place. It's a large base. It's not tight like this one. You can see this one's tight. It's small. It's clean, right? It's not sloppy and with a lot of tails and all that, right? The tighter the base, the tighter the stop loss, right? In this case, the tighter the base, we have a smaller stop size here than there, the better the reward versus risk. Because think about it. We're risking $100 in each of these setups. However, because we have a smaller base here, we have a smaller stop size. With a smaller stop size, we're able to purchase more shares, right? If we're able to purchase more shares, well, that means our reward is a lot higher, right? Like if this goes up $1, right, we're going to make $1,000. However, in this situation, with this entry and with this stop loss, if this goes up $1, we're only going to make $333, okay? So we're risking the exact same amount, but our potential reward with this tight base and this small stop size is significantly higher. So guys, always look for tight bases, really clean, tight bases, as opposed to really sloppy bases that are all over the place, because the risk to reward is going to be way better. And honestly, the tight bases, the clean looking bases that are not sloppy, they tend to work a lot more often too. Okay. And like we talked about, we have the share sizing formula. It's going to be your risk, your dollar amount risk divided by your stop size. Okay. And in order to calculate stop size, just subtract your entry from your stop loss price, right? $3 minus $2.90. And how are we setting? Where are we getting $3 and $2.90? Well, remember, the entry is over the base. The stop loss is under the base. So when you see a base like this, draw a line over the base, see what price that is. Draw a line under the base, see what price that is. Okay? And we're going to be talking about share sizing and risk management, and we're going to go a lot deeper into this reward versus risk concept a little bit later in the course. Now, let's talk about the shakeout bar. And guys, I can guarantee you there is nobody else talking about this. Okay, there's nobody else presenting this sort of information to you. And the reason I say that is because I learned this by myself. I learned this through experience, okay? And the shakeout bar is an incredible enhancer to the breakout, okay? This is something that I have just seen through my years of experience and through looking at thousands of different charts and looking at thousands of different breakouts and breakdowns. So the shakeout bar improves the quality of the base, and it makes it a lot more potent of a base breakout or breakdown. This increases the odds of success for your breakout or your breakdown. And it makes the setup battle tested. That might sound confusing. You'll understand it in a second. And what it does really is it makes a bullish base, right? Remember, if we have a bullish base at the highs of a rally, it's going to make that base even more bullish. It's gonna kind of give you confirmation that this is definitely bullish. This is probably going to continue higher. And it gives a bearish base, right? That's basing at the lows of a rally. It's going to make it even more bearish. It's going to show you that there's actual bearish confirmation. And it triggers stop losses. We're going to talk about that in a second. And like I said, it's a trading enhancer. It's a trade enhancer. It makes me immediately more confident that this breakout is going to work, or this breakdown is going to work. So let's look at it. So in plain view, this is the shakeout bar. And a shakeout bar, if you're looking at it, you might recognize it immediately. You might say, hey, listen, that's a bottoming tail. And you would be exactly correct. This is just a bottoming tail. You're absolutely right. However, what does this bottoming tail do for us? And what this bottoming tail does is picture as this breakout is forming, right? Let's say a bunch of people have already entered the breakout, right? Or let's say a lot of people, they're in it long from here, right? They bought it down here. They haven't sold it here. They're waiting to capture bigger profits. And let's say during this base, all of those traders, all of those buyers, they set their stop losses. They're going to set it under the base, right? That's where we're supposed to set it. We're supposed to set it under the lows of the base because that's where we have an area of support. And that's where they're going to be setting their stop losses. Now, when this bottoming tail forms, and right, we know that when a bottoming tail forms, it drops in price before the buyers show up here and bring it right back up. Okay, so it shows us that the buyers are taking control. And what this bottoming tail does, right, as it's dropping, it's triggering every single stop loss that is at this support level. And by triggering all of those stop losses, right, all of those stop losses, they're sell orders, right? They're sell orders to try to get out of the position, right? As they're triggering all those sell orders, it brings the stock or crypto even lower, right? Because if all of a sudden we trigger a bunch of sell orders, that's even more selling pressure. And as a result, we drop even more. But despite us dropping all the way out and breaking down out of this bullish base, if we end up rallying right back higher, that is confirmation that this stock or crypto is indeed bullish and we will continue higher. This is confirmation, right? This is showing you that the buyers, they're not allowing this stock or crypto to continue lower. No, as soon as it tried to drop, it went right back up. That is, in essence, what a shakeout bar is. And this is when I say battle tested, meaning the sellers showed up. The sellers tried to bring this lower, but there was so much buying pressure that they brought it right back up, and then it continued to base at the highs, right? And this is a very bullish sign, right? We want to see this sort of bar when we are basing, okay? It's the same idea here. After a drop, right, we have an area of resistance over the highs of this base. And a lot of people are placing their cover orders, right? Let's say people shorted it here, right? And they're enjoying their profits, and now it starts to base and they want to capture additional profits. They place their stop loss over the base, as they should. And as soon as buyers start to show up and they trigger that stop loss, a bunch of buying happens, right? Because that's where people are covering their shorts. So they're covering their shorts at this position, and we see a rally higher. However, it ends up just being a topping tail. And remember, guys, a topping tail suggests that the sellers have taken control. So basically, the buyers showed up. The buyers attempted to bring this stock or crypto higher. However, the sellers said, hey, not so fast. And there was so much selling pressure, excuse me, that they brought the stock or crypto right back to the lows, and it continued basing, and then eventually finally break under this support, and we continue lower, okay? And you can also call this kind of a breakout failure. You can call this a breakdown failure. It's a topping tail as well. So this is why it's so important for you guys to understand and be able to identify the different candlesticks that exist, because you'll be able to find information like this, where if you see, oh wow, we have a topping tail during a very bearish base, that's a good sign that that's good confirmation that we're actually going to continue lower. Hopefully that makes sense. Now, let's talk about breakout and breakdown failures, okay? And a bullish base that has a breakout failure, which is in other words, a topping tail, especially on high volume. And we haven't talked about volume yet, but this is when we're going to begin discussing it. Whenever we have a bullish space that has a breakout failure on high volume, that is a sign that a reversal to the downside might occur. And with the opposite, let's say we have a bearish base, right, at the lows of a rally, at the lows of a drop, right? If we have a breakdown failure, which is a bottoming tail, right? We try to go lower, but we fail, especially in high volume. That's indicative that a reversal to the upside may occur. And guys, this is also information you're frankly not going to find anywhere else, because these are strategies that I personally found through my years of experience. All right, so let's kind of walk through this. We're first going to be talking about the breakout failure with the topping tail. So we have a large rally and we begin to base at the highs, right? So far, so good. All of a sudden, we break out, right? The buyers, they bring this stock up or crypto up and we break out of the base. However, this is very short-lived, and then the sellers take control at the top here and they bring the stock or crypto right back down, right? That's what a topping tail is. It suggests that the sellers have taken control. So during this bullish base, rally higher, we're basing bullishly, we're basing, okay, everything's looking good higher. We finally break out, right? But ends up leading to a topping tail like this. This is a breakout failure. And the market speaks loudest in its breakout or breakdown failures. It speaks loudest in its failure patterns, right? So we base, we have a breakout, leads to a topping tail. The breakout has failed, especially if this is occurring on high volume. We're going to be talking about that more in the volume class. But this is usually indicative that this move is done. This move is over. It attempted to break out and failed. What does that tell us? If it attempted to go higher and failed, it tells us, hey, this is probably going to go lower. And this is indicative that a reversal might take place and this will actually drop. Just like here, let's say we have a, excuse me, let's say we have a drop in price. We are basing bearishly, right? We're basing at the lows, which is indicative of weakness. We attempt to break down. However, it leads to a bottoming tail, meaning we attempt to break down, but we just shoot right back up, right? Leading to a bottoming tail. What does a bottoming tail tell us? It tells us that the buyers have taken control, and usually it's indicative of reversal and reversal to the upside. Okay, well, I mean, it's really not too difficult, guys. Think about it. If we drop, we're basing, it's looking lower. We attempt to go lower, right? We attempt to break down and drop lower. However, the buyers show up here. They bring prices right back up, and that usually means. It might mean that we're actually going to end up reversing and continuing higher, right? I mean, it makes sense. We try to go down, we fail, it probably means we're going up. If we try to go up and we fail, probably means we're going down, okay? So, key characteristics about the breakout. Basing at the highs of a rally is bullish. If we make a rally higher and we're basing at the highs, that is bullish. It shows strength. It shows that there is positive buyers, like there's buying pressure. The longer it bases, the more bullish it is. Okay, so we want, if we're basing at the highs, we want a long base. We want a base that's, ideally longer than shorter, because it shows that, hey, this is just taking a little bit more time to correct itself, but there clearly aren't enough sellers to bring it down and make it break down out of the base. So we're probably going to go higher. Basing at the lows of a drop is bearish. And the longer it bases at the lows, the more bearish it is. I mean, it makes sense. Okay. If it's at the lows and it's staying at the lows, it probably means it's lower. If it's staying at the highs for a long time, it probably means it's higher. Basing at resistance is bullish and indicates a break of resistance may occur if the breakout triggers. Okay, so if we are at a previous resistance point and we're basing at that resistance, it probably means we're going higher, right? Because if we're at a resistance level, right, usually you would expect us to drop. But if it's basing at that resistance level, it probably means we're going higher. If we're at a support level, right, and if you've already identified support on maybe the other time frames, if it's basing at support and it continues to base at support, then it probably indicates that a breakdown is probably going to happen and we're most likely going to continue lower, okay? And let's just want to make sure, okay, let's just make sure we look at some examples. So we have a rally, we begin to base. We enter above the base, we enter, oh, and now we have another base, right? We're going to enter at this red line, which is over the highs of the base. Then we get that pullback. We saw a diagram of this earlier where this prior resistance is now becoming support, right? And this is a buy setup, where we're going to talk about that in the next class. We rally higher, and this is sort of a little bit of a base, and another buy setup here, okay? Let's look here. We had a rally before this. And another thing to note here, guys, notice how the 20-day moving average is underpriced and it's trending higher, okay? And we didn't quite...
I would never teach you guys anything that I don't personally use in my trading every single day. And what I'm about to show you is my personal favorite trading strategy. I literally trade this setup every single day in the markets, ultimately because of its simplicity. One of the reasons I am a profitable trader is because I like to keep things simple. I think the simplest things in life are oftentimes the most brilliant, and that 1000% applies to trading. I see so many unprofitable traders out there that struggle because they overcomplicate their trading. They use fancy strategies, crazy indicators. They use those buy and sell markers on their charts, and they just overcomplicate their analysis. And what I'm going to show you is a fundamental strategy that I guarantee you've heard of. I guarantee most traders have heard of this, but only a small percentage of traders actually succeed trading this strategy, and I'm about to tell you why. And this setup, ladies and gentlemen, is, drumroll please, the base breakout, the base breakdown. And you might be thinking, oh yeah, I've heard of breakouts and breakdowns. Maybe I even trade breakouts and breakdowns. And you might be thinking, oh, don't all base breakouts fail? Like, that's a common thing I always hear. Oh yeah, breakouts fail. Well, yeah, there are thousands of breakouts and breakdowns that occur every single day in the markets. But our goal as traders is to only trade the highest quality of breakouts, right? The ones that are going to have a high reward to risk, that are going to be high probability, that are going to be high quality. And we want to avoid the low quality breakouts and breakdowns. And in this video, I'm going to explain exactly what to look for, what criteria to follow, how to identify high quality breakouts versus low quality breakouts. And this is ultimately what's going to make you profitable trading this strategy. If you're able to find what's called amplifiers. And amplifiers are essentially, criteria that make a specific setup higher quality. And I'm going to go over every single amplifier for the breakout and the breakdown. But step one for trading this strategy is you need an established uptrend for a breakout, and you need an established downtrend for a breakdown. This is really, really simple, right? What's an uptrend? Higher highs, higher lows, right? So what does the uptrend tell you? Well, uptrend tells you where prices are heading, right? And we as traders want to trade in the direction of the trend, right? You could be a reversal trader, but for the purposes of the strategy, we want to be trading with the trend. I mean, think about it. If you're driving on the freeway, on the highway, do you want to drive in the direction of traffic or do you want to drive against it? Well, if you drive against the flow of traffic, well, that can be very dangerous. The same thing with trading. If you trade against the trend, that can be very dangerous. And once you've identified that there's an uptrend or a downtrend, great. You need to understand why the breakout even exists. Like, what's the concept behind the strategy? And to understand that, you need to know what price correction is and what price correction is within an uptrend or a downtrend. So let's get into it. So I want you to imagine that you just ran a marathon. Literally, imagine you just ran the New York City Marathon, what's that, like 25, 26 miles, right? Think about it. You just finished the marathon. Would you be able to immediately run another marathon? So you just ran 25 miles. Would you be able to run another 25 miles? Well, unless you're David Goggins, you need to rest. You need to sleep. You need to eat. You need to hydrate yourself. You need to relax. You need to, get some rest, right? And the markets move in very similar ways, right? Unless you're David Goggins and you could just run marathon after marathon, you need to rest before you can run the next marathon. Well, the markets move in a very similar way. Whenever prices run a marathon or have a big rally, it can't just, run up forever. They can't just move up, like to infinity, right? Prices also need to rest. And you could think of this resting period as like a correction, right? Prices need to correct before they can run the next marathon or before they can have the next rally higher, right? And there are two ways in which prices can rest or correct. These are the only two ways. Either a retracement where the market runs a marathon and then it rests and corrects through a retracement. This is kind of like a buy the dip, right? That's the theory behind buy the dip, right? You get a big run up and we retrace, we correct, and then we get ready for the next marathon, for the next rally higher. The other way in which we can correct is through a consolidation, right? This is when you literally rest, right? The markets move up, they rally, and then they just stay at the same price. So the definition for consolidation is a period of time when the stock is trading within one particular range. It's not moving above that range. It's also not moving below that range. It is literally resting within that range. So these are the only ways in which prices can correct, in which prices can rest. And you probably are already getting, ideas of like, oh, I get this, right? Within an uptrend, prices are moving higher and we find corrections within an uptrend, and those are opportunities for us as traders. And you're absolutely right. And that's what we're going to go over right now. In other words, by trading a retracement, by trading a consolidation, in other words, trading a, correction pattern, you're trading the continuation of an established trend. And in my opinion, that's the easiest way to make money with trading, to trade the continuation of an established trend. Always remember that the trend is your friend, and our goal is to spot retracements and consolidations or breakouts within established uptrends in order to make money. So hopefully you're starting to see this. And if you want to learn how to trade the retracement pattern, I actually teach it in my free 10+ hour course. You could find that in the description of this video. My free course is genuinely better than most paid courses on the internet. So it'll build the foundation for your trading, and you could use a lot of what I teach in my free course in conjunction with my YouTube videos to solidify that trading foundation of yours and actually begin making money. So next, what I'm about to talk about is very, very important, and that is your entry and your stop loss for the base breakout, for the consolidation, which is what we're talking about in this video. And this is especially important because as traders, it's important to have structure within your trading. I see so many traders out there who have random entries, random stop losses, random targets, random execution, random management, and nothing in their trading is predetermined. They don't have structure. And yeah, I see people online all the time that are like, yeah, I'm entering here. And there's no reasoning behind that entry. So with this breakout setup, you're going to know exactly where you're going to enter and where you're going to be placing your stop loss. And theory behind the entry and stop loss is as the stock is basing and consolidating, right? You could think of the top of the base as like a resistance area, right? It kind of retests that top of the range and it retests the bottom of the range. So the top of the range is going to act as a resistance area within this consolidation. And the lows of this range, the lows of the base, is going to act as a support area. And the reason that theory is important is because for the base breakout, we want to time our entry as prices are breaking out of that range, as they're breaking through that resistance, which is, at the top of the range. And we want to be placing our stop loss below the base, below the range. In other words, below the support area at the bottom end of this base. So entry over the base, stop loss under the base. That's just an easy way to think about it. It's extremely simple. And just having this entry and stop loss model within your trading, you're already ahead of like 70% of traders who just operate completely randomly. So always remember, you have a base breakout, entry over the base, stop loss under the base. If it's the opposite, if it's a breakdown, it's entry under the base, stop loss over the base. It's very easy, right? And with having a predetermined entry and stop, it's going to make your life a lot easier when it comes to risk management, which we're going to get into in a second here. So easy enough, entry over the base, stop loss under the base. All right. Next, we have the 20 period moving average requirement. And I actually made a separate video a couple weeks ago about the 20 period moving average and how I use it. So I recommend actually watching that video after you watch this one. But essentially, for the 20 period moving average, for the uptrend that we've already identified for this setup, we want the 20 MA during the uptrend to be under prices trending lower. We want trending higher. So we want a rising 20 MA that's trending higher, under price trending higher, under price trending higher, under price trending higher. That's what we want to see for the 20 MA, right? So we see this really nice uptrend. We want the 20 MA to be under price trending higher. And if you watch the 20 MA video, you'll see how well prices respect the 20 period moving average within trends. And the opposite applies for a downtrend. The 20 MA is overpriced, trending lower. And that's exactly what we want to see for a downtrend. Overpriced, trending lower. All right? So opposite for an uptrend. Next, our goal is to look to buy when prices are close to or near the rising 20 period moving average for a breakout, right? So we have that initial rally, the initial move up. At this point, we're extended, right? If you watched the 20 MA video, we're extended from the 20 period moving average. You could think of this as we're overbought. And from there, we need to rest. Prices need to correct in the form of a consolidation. And that's when we rest, we correct into that rising 20 period moving average that is underpriced trending higher. And we want to be timing our entry with the consolidation, with the base breakout when prices are close to or near the 20 MA. And this is exactly where we want to be timing our entry right here. All right. So easy enough. This is literally the only indicator I really use is the 20 period moving average and the 200 period moving average. Now the 20 MA, it's crucial for this breakout pattern. All right. So very important. You want that rising 20 MA. You want to see it consolidate into that rising 20 MA. Or if it's a downtrend, you want to see it consolidate into the declining 20 MA. All right. Now, one extremely important factor when it comes to the base breakout or base breakdown is the quality of the consolidation. We want to see tightly ranged consolidations. We want to see them tight. We want to see them almost like in a tight range. We don't want sloppy consolidations, and we don't want a lot of bottoming tails or topping tails. And I'll show you what that looks like in a second. The tighter the base, the tighter the range of the consolidation, the tighter the stop loss, therefore the better the reward to risk. And I'm going to explain how that makes sense, right? So what we want is a tight base here. Let me kind of zoom in, right? We don't want a sloppy base. We want a base that's tightly ranging, and then we trade the breakout. We don't want it to be, all over the place, and then we trade the breakout, right? We want tight bases. And this is why, right? It all comes down to your reward to risk. So right here, we have two different consolidations, two different bases. This one is very tight, very clean. It's not ranging all over the place. This one is the opposite. It is ranging all over the place. It's up, it's down, it's up, right? So let's say our entry for both of these setups is $3, right? Over the base, $3 for both of them, right? However, let's say our stop loss for this tightly ranged setup is 290. However, our stop loss for this, sloppy consolidation is 270, right? Because it's a wider base. You're going to have a wider difference between the entry and your stop. If we're risking $100 on both of these trades, right, what would be our sizing? And we're going to be using this formula, which I talk about in other videos. It's essentially your risk divided by your entry price minus your stop loss price. This is how you size your positions. This is how many shares you need to buy for that position. So if it hits your stop loss, you only lose your predetermined risk. I talk about this in other videos as well, and in my free course in the risk management section. So watch that. Right, but let's say $100 risk divided by what's the difference between the entry and the stop, right? $3 minus 290, that's a 10-cent stop. $100 divided by 10 cents is 1,000 shares. So for this breakout, we're able to get 1,000 shares. However, in this case, since we have a wider stop, instead of it being 100 divided by 10 cents, right? $3 minus 270, that's 30 cents. It'd be 100 divided by 30 cents, which is 333 shares. You're risking identical amounts of money in these examples. You're both risking $100 on both of these setups, right? It's the identical risk. The risk remains constant. But what changes is the amount of shares you can get. And this obviously has just a way better reward to risk. You're able to get more shares on the same risk because you have a tighter stop. And the reason you have a tighter stop is because you have a tighter consolidation. You don't have a sloppy consolidation like you do here, right? This is why we want tight ranges, tight breakouts versus, crazy crazy and sloppy breakouts like this, all right? And overall, when you have a tighter range, tighter consolidation, you end up getting way better continuation on that setup as well. So that's also really important. So here are a couple of examples of very sloppy consolidations, right? Like you're seeing this, it's like up, it's down. Let me get the different color here, and let me make it super thick. Okay, you see it's up, it's down, up, down, right? It's all over the place. You could see that during this base. It's like sloppy. Even during this, like we're up, then we're up. It's not tight. It's a very sloppy base. So these are good examples of sloppy bases. These are good examples of what you want to avoid. Even right here, right? Let me get the black one out. Right here, you get the move lower, you retrace, and you see how sloppy it is. It's all over the place before you break down, right? So in this case, the entry would have been below the base, stop loss above the base. But that's such a big stop because it's such a sloppy setup. All right, does that make sense? So in summary, you want tight ranges, a tight consolidation for better reward to risk. All right, makes sense? Now, let's go ahead and just look at some examples of this, right? So that's the strategy, right? We got the 20 MA requirement. We know where our entry is. We know where our stop loss is, and we know we want tight ranges, tight consolidations. Let's take a look at some examples here. All right, so this first example is actually Ethereum, and this was literally just a few weeks ago. Take a look at this breakout right here. So Ethereum was on a multi-month downtrend, and then all of a sudden we bottomed here, then we based, and then we kind of had that initial breakout over the base. But this wasn't the interesting one. This was the interesting one. So we move up, and then we consolidate right into that rising 20-period moving average, and then we pumped like 40% on Ethereum. And you could see how tight of a range this is. It is such a tight base. So that's where your entry would go. It'd be over the base. You could put your entry here or over the base here. Stop loss under the base right here. And that would be your entry and your stop. An unbelievable breakout opportunity. Literally on Ethereum, almost picture perfect breakout on ETH. And I was actually buying a ton of it throughout this entire area. I'm very, very bullish on ETH, not only from a price action perspective, but long-term as well. Here's another really, really good example, right? On APLS, we kind of started to, we moved down a little bit, and then we started to base into the rising 20-period moving average. I think this was on a gap up, which I'll talk about in a second. So this thing gapped up and then just consolidated. And really, really clean. Entry over the base, stop loss under the base, and you would have caught that move. Very, very nice. Let's move on. This is another really, really beautiful setup. I mean, take a look at how tight the base is. Not sloppy at all, like right here, right? Take a look at this. We dropped, we retraced. So it's kind of like a retracement pattern as well. And then we consolidated, then entry below the base, stop loss above it, right? Beautiful, beautiful breakdown, right? Maybe not right into the 20 period moving average, but remember, it doesn't have to be exactly at, it just has to be near the 20 MA. And I consider this pretty near the 20 MA. So excellent, excellent setup. I actually made money on this one. So all these trades are trades that I've taken before. Here's another really, really excellent example as well. Check this out. Consolidation, breakdown, right into the 20 MA, entry under the base, stop loss below. Then we dropped, consolidation right into the 20 MA. We got a breakdown, entry below the base, stop loss above. And that thing just I mean, from what? 90 bucks all the way to like $63. Insane move, right? And it's simple, right? We're essentially just trading the continuation of the trend in a really, really intelligent way, right? Let's look at an example actually from yesterday's trading. So let me point exactly where this was. So this is the 5-minute chart, and a lot of people might be wondering, hey, what time frames do you use for the breakdown? It's all about using multiple time frames. I'm probably going to make another YouTube video about this, but it's not about using one time frame. It's about practicing multiple time frame analysis, and you are looking for multiple time frame alignment. So if you look at it, this was at around 12 o'clock. It started to base, right? So this thing dropped the entire day and then kind of, did some sloppiness right here, but then it started to drop and then it started to actually consolidate really fluidly. Now, this was on the 5-minute time frame. So this kind of set the bias here, right? The 15 and the 5 set the bias that this was downtrending. And then right here between 12 and 12:30, so this area right here, I actually screenshotted the 1-minute chart. It was between right here all the way to right here. You could see on the 1-minute chart, look at how well prices are respecting the 20 MA. And check this out. We have a base breakdown. We based right into the 20 MA, small little breakdown, continue to base, small little breakdown, continue to base, small breakdown. And then this is where it really accelerated, where it based, look at this, such a tight base. It wasn't like this. It was literally like a very, very tight base and then breakdown, right? Very tight base, breakdown, then based again, breakdown, braced again, breakdown, based again, breakdown. This is what I call a stair step, where you drop, base, drop, base, drop, base, drop. Or the opposite, where you go up, base, go up, base, go up, base, go up, base. This is a stair step. If you ever see a stair step, it's literally some of the easiest money that you can make in the markets. Seriously. And unfortunately, I actually missed out on this. I was away for lunch at 12, and I only came back at like 12:45, not even at 12:50. So I was already late to the move, but unbelievable setup, honestly, unbelievable. And this was literally yesterday, right? So it's important to look at multiple time frames. And yeah, just beautiful. You can see how well it's respecting the 20 MA. And this is what I do every single day. I find established trends, and then I find breakouts and breakdowns within trends by using the 20 MA, by, of course, looking for really, really quality setups, tight bases. And then from there, I'm looking at multiple time frames, and I'm also using level 2, which I teach in other videos. So yeah, and this is exactly how I do it. Now, there's also another very, very key amplifier that you could use when you combine these setups with gapping stocks. Now, what is a gapping stock? That is an overnight change in price. So a stock, closes at $5 yesterday, and then the next day it opens at $8. That $3 difference overnight is a gap. It's an overnight change in price. You could literally see the gap in the chart. And I trade gaps. I'm a day trader. I love trading gaps. And the gap sets the bias. And then from there, I usually trade that bias through a breakout on the intraday timeframes, which I'm going to show you a bunch of examples in just a moment. And 80 to 90% of the time, I'm trading in the direction of the gap. there's this idea that all gaps fill. Everyone will tell you that, oh yeah, don't trade gaps. All gaps ultimately fill. Maybe long term, you could find me a statistic saying that all gaps ultimately fill the gap, over a course of a year or two. But in terms of the day of the gap, yeah, there are some gaps that fill, but there's a ton that follow through and continue with the gap like crazy. I've been trading gaps for 5 years. This idea that all gaps fill and that you should not trade gaps, that is nonsense. It is bullshit. I'm going to show you examples of it right now. I trade gaps for a living. I trade the continuation of gaps, meaning if it gaps up, there's an overnight change in price to the upside, I usually go in the direction of that. I go long during the intraday. Or if it gaps down, overnight change in price to the downside, I usually go in the direction and I'll look to go short. I do this 85% of my setups are that. So that is bullshit, that all gaps fill. It's not true, it's a myth. So, and this is what I do. The gap establishes a bullish bias if it's gapping up on the higher time frames, and then I trade that bias on the intraday time frames via a breakout or a breakdown. And the reason gaps occur is because of news, earnings, events within the company. There could be all sorts of reasons on why prices change overnight. I'm not really concerned with the reason. I'm concerned with what that gap is doing to price. I actually have another video on my YouTube channel. This strategy is boring but makes me 50K a month. That video goes over gaps, and I go over how I combine gaps with this strategy as well. So let's go over a couple from the last few days. So I've had people comment under my videos saying that I cherry pick specific charts from like years ago that, perfectly represent the ideas that I am teaching. But all the stocks that I'm about to show you are ones that I've either made a lot of money on over the last literally like 2 to 3 weeks, or stocks that were on my watch list, they were on my radar, and maybe I just missed them. But most of these stocks I actually traded and made money on. The first one was Open, and I used the replay function just to make it less confusing and kind of go back to the specific day which this happened, which was on May 9th, which was just a couple of weeks ago. So Open closed at 87 cents the previous day. The next morning, it gapped and opened at around 70 cents, 69 cents, directly below this downtrend, below support, below into all-time lows. So since we were clearing support and gapping down, that gave me a bearish bias. And then if you go to the 5-minute chart, you see just a few picture-perfect breakdowns here. So at first, it actually got bought, then kind of settled down. And my first entry was right here, caught this move lower. And then I exited, took profits, and then I started shorting it again right here on this base, dropped, based, and then look at this flush lower. This was my biggest trade on that day. I think this made me in total $4,600, something like that. Insane breakdown. It was beautiful at the time. And this was on such a tight stop. Literally, it was a penny stock and there was no spread. The stop was like 0.0002. It was like insanely tight. So I got massive size. I had like 100,000 shares in this thing. All right, so this was a really, really perfect example of that. Here's another fantastic example on Coinbase. This was on May 13th, and this was actually my biggest miss of the week. I got shaken out of this trade, and I wasn't able to fully capitalize on it. I will be transparent. It made me, it was just crazy. It was crazy. This next one is on Coinbase, and this was on May 13th, and this was an unbelievable play that unfortunately, I will be transparent, I missed out on. I mismanaged this and I wasn't able to capitalize, but take a look at this. We bottomed at around 144, then we started to kind of chop around. We had that rising 20 MA. We closed at 206 the previous day, and the next day we gapped up around 12%, which for Coinbase, it's a $200+ stock. That's pretty significant. We gapped above this entire resistance area, right? So let me get the tool. We gapped above this entire resistance, and we also gapped above the 200 period moving average. And we had we had no resistance until literally like probably this pivot, even it could have even gone higher. We had literally absolutely no resistance. It was an amazing gap up. So I saw the gap, and this gave me a bullish bias. Then you go to the intraday time frames, let's say the 5-minute chart, and you could see just a beautiful breakout right here. You could have played over the highs, stop loss below, and what that's at 240, 250 entry, 238 stops. So it's like a $4 stop, and this thing ran to 260. So it's like 4 or 5 Rs, and you could have even used a tighter stop as well. And in fact, there was an earlier entry on it right here. You could have said that, hey, rallied, based a little bit. I remember I called this out in my group. I had a bunch of students that printed on this, but I mismanaged it. Anyway, that's fine. I know exactly what I did wrong, but you could have entry over this base, stop loss above. Oh, I'm sorry, stop loss below. So entry over the base, stop loss below, and then you could have even added to it over this base and then moved your stop loss up. So it was a fantastic, fantastic example. And you can even see how well prices were respecting the 20 MA on the pullback, on the retracement, right here, here, here. It was an amazing just power trend that day, ignited by the gap. So the gap gave me the bias, and then we traded the bias of that gap via a breakout on the intraday timeframes. Here's another unbelievable gap and example. The previous day we closed at 232, and then the next day we opened at 188. So what, this was like about a 20% gap, and we were gapping directly below the all-time lows, directly under support. We were gapping directly below this move higher. It was beautiful on this DCGO. I think I used this example in the other video just because it's a picture perfect gap. And it was a really nice setup on the intraday timeframes as well. And I was able to capitalize. I don't remember exactly how much I made, but I remember I made at least, I think it was 1,000 to 2,000, something like that. And you could see the breakdown right here, where we dropped, then we kind of retraced, moved back in, and then we had a breakdown setup right here. It's probably a little bit cleaner on the 15. You could probably see it a little bit better. Yeah, so we dropped, we based, and I remember this stock, it was hard to get filled on a lot of the times, but entry below the base, stop loss above the base, right? And I think there was there was another base breakdown, the smaller time frame. Yeah, the first one, it's gonna look really weird on TradingView. On my Thinkorswim platform, it looked a lot cleaner. It's gonna look super wild. It didn't look like this on Thinkorswim, but that was actually my first setup on it. I stop loss here, and then entry under the base, and then we caught that move lower in my group. And that was fantastic. That was a fantastic play. So same thing, unbelievable daily gap down, which set the bias that it was gonna go lower, bearish bias. And then we traded that bias on the intraday timeframes via a 15-minute and 2-minute breakdown. This video is getting long, so I'll do one more, and this was on Wolf. This was my biggest trade last week. I remember distinctly because it was pretty recently. This was May 21st, so it was only like a week ago, literally. So I made, I think, $5,600 off the Wolf. And by the way, I post all my results every single day on my Instagram story as well. So I highly recommend following me on Instagram to see my daily P&L. So this thing gapped down a lot. It gapped from what, 312 all the way to like 110. It was like a 60% plus gap. I call this kind of like a mega gap, where it's a massive, massive gap. And whenever you have massive gaps like this that are, 60, 70 plus percent, they can actually go either way, right? I usually would have a bearish bias on a gap down, but when you have a really big gap down that's really under support, right? Like this was super under support, it could actually get bought. So we'll go to the intraday timeframes, and you're not going to see this because I did it off level 2 as a scalp, but off the morning I got 5K shares at 110, stop loss 115. So I was only risking like $250, and I was able to kind of manage this, and I took profits around 92 cents. So off my first trade on it, I made like $750 off level 2, and I kind of scalped it lower and held it and took profits around here. But the real trade in the breakout was right here. So this thing dropped, ended up bottoming at around 82. I was scalping this on the way up, but off level 2, but that wasn't the real trade. Right here, we moved up, we started to base, rising 20 period moving average, entry above the base, stop loss below the base. And I actually sized up. My risk is definitely discretionary. Sometimes I size up on really, really high quality setups. I sized up on this one. It also had a really nice level too. So I got in around 103, 104, something like that. I I think my by the end of it, my average price was 105. I had like 25,000 shares. I sized up, and I got in using level 2 as well. But the entry here is really breakout entry above the base, stop loss below, and I caught this move higher. My first exit, I remember, was at 118. So I had 25,000. I took profits at 118. And then you see this little tail right here. We got back in off level 2, scalping it. And there was a retracement on the intraday time frame. So we got back in at 112, rode it to 125. And then I think we had one more move on it. But by the time it hit 140, I was more or less out of my full size. And this was a beautiful breakout as well. So the idea here is we use gaps to set the bias, and then we trade that bias via the breakout or breakdown on the intraday time frames. Hopefully this makes sense. Video is getting a little bit long, guys. Hopefully, you could begin applying this in your trading and use all of these things. So in summary, we use the gap. We looked at a bunch of examples of really clean base breakouts, right? We don't want to see sloppy bases. We want to see clean, tight ranges because they give you a better reward to risk, and it also gives you better follow through. The less sloppy, the better it is, right? So that's what this covers. And then from there, we used the 20 MA to our advantage. Watch the 20 MA video. We wanted under price trending higher for an uptrend. We want to see prices consolidate into the rising 20 MA. And of course, you understand the whole price correction thing. It's a very, very simple strategy. Like, you're probably looking at this video like, yeah, this is really simple. This is what I do every day. This is by far my most profitable strategy. And it's the first one that my dad taught me. All right, guys. So very good. Make sure you like, make sure you subscribe, make sure you leave a comment if you enjoyed this video. And I actually am a little bit sick. It took me like a few hours to record this video. I'm a little sick, but hopefully you really enjoyed it. And if you're someone who's looking for a hands-on mentor, you want to trade live with me every single day, you want me to take you under my wing, teach you from A to Z, and scale you from $0 to $10,000 to $50,000 a month with trading, that is exactly what I do with my mentorship students. I scale and coach them to become profitable traders and ultimately full-time traders. That is the purpose of the mentorship, is for you to change your career and become a full-time trader. And I help you do that. I'm very selective with who I work with. So if you're interested, if you want more details, if you're really looking to take that next step in your trading, there's an application below. There's also a video in there that'll give you all the details. You could apply, book a free call, no pressure. We'll see if it's a good fit for you. Hopefully you guys enjoyed this video. Thank you very much. I'll see you in the next one. What is going on, guys? Glad you're watching this class. And today we're going to be talking about the buy setup and the sell setup. In other words, the pullback or retracement pattern. And I know we talked about the base breakout and the base breakdown during the last class. And I believe the stream cut off while I was actually looking at some examples. So I want to go ahead and finish the examples that we were looking at before we continue on into the buy setup. Okay, so let's go ahead and do that. Okay, play from current slide. So we talked about this example. So looking at this example, number one, the 200-day moving average is under price. It's under the 20-day moving average. That's a bullish sign. You usually want to see the 200 generally under price, right? You want the average, the 200-day moving average to be below price and the price to be above that average, okay? We had a prior rally here and we ended up basing, right? Our entry is above the base. Our support is, or our stop loss is under the base. And notice that as soon as we begin to break out, or right before we actually begin to break out, the 20-day moving average starts curling under and trending higher under price. Okay, and that's when we start to see the breakout. And we're going to be talking about the buy setup today. Same thing here. 200 is all the way below price and below the 20. We have the 20-day moving average. Notice that as soon as it starts to break out here, it starts to rise under price. It's trending higher, right? You could see that there's clearly bullish momentum with the 20-day moving average. And as soon as we base into that 20-day moving average, that's when we break out, okay? So our entry would be over the highs, stop loss would be under the lows, okay? Hopefully that makes sense. So those are just some examples of it. And later in the course, we're going to be looking at some charts and actually pinpointing different breakouts, different buy setups, and also looking at the other patterns that we're going to be talking about. So let's go into the buy setup.
And the buy setup, as you may recall, is one of the other fundamental strategies that I talked about. We talked about how price tends to correct itself in two ways, either through time, or in other words, base it consolidating. We already learned about that last class. Now we have to understand that price can also correct itself through a pullback, through a price correction. Okay, so what is it? And this is ultimately correctly buying the dip. We always hear that phrase, buying the dip, right? I think it was coined in 2020 when all stocks went up, all cryptos went up during the COVID pandemic, right, or after it. And a lot of people, frankly, they lose money when they buy the dip. Most people, most amateurs, they lose money when they're buying the dip. But what I'm going to show you today is how to correctly do it. What characteristics you should be looking for when you're actually buying the dip. Because I'm making money buying the dip. I know other traders making money buying the dip. There's no reason you shouldn't be making money when buying the dip. And I'm going to show you exactly how to do that. This is one of the most potent trading strategies for day and swing trading. It works on any time frame for any stock, crypto, forex, any financial instrument that operates in a market. And it's really important to develop the skill set required to identify when to be buying the dip, right? When or identifying what is a high quality buy setup or pullback pattern. So like we did with the base breakout, let's try to analyze the anatomy of the base breakout. Of the buy setup. Sorry about that. So number one, we have a rally, right? A lot of the people who bought it down here, they want to start taking profits. So what they do is they start selling, right? They sell at this point and we see a minor pullback. What we want to do, and during this pullback actually, this is price correcting itself, right? That's why it's pulling back. But what we want to do is time our entry for when the pullback and the correction is finished. So we buy here and enjoy the next move higher. Again, we begin the pullback. We want to buy when the correction and the pullback is finished and enjoy the next move higher. Okay. Also, guys, for the buy setup, this is kind of a big, this is a requirement. You need to have an established uptrend in order to trade the buy setup. You need an established uptrend, especially if you're a beginner. Make sure there is a present uptrend before you consider playing the buy setup. And the buy setup, of course, occurs after the pullback has completed right here. So let's go over some key criteria for the buy setup. And ultimately, the buy setup, really, we're buying after a pullback, right? So following a rally higher, right, you want to have 3 or more consecutive red bars in a row. And you want to have 3 or more consecutive lower highs in a row on the pullback, right? So right now, we're trying to analyze the quality of the pullback, right? We want to be looking for specific types of pullbacks when we're analyzing a buy setup, okay? So one of the criteria is, like I said just now, you have to have 3 or more consecutive red bars, right? We have a red bar, red bar, red bar, red bar. We have 4 in this case. Perfect. And you also ideally want to have 3 consecutive lower highs, right? What does that mean? Right? We have, this is a high of this red candlestick. Then this is the next high of the next candlestick. This is the next high of the next candlestick. And this is the next high, right? Notice how every high is lower than the previous one. Notice also how every low is lower than the previous low. That's what we want to see. We don't want to see we're down, then we're up, then we're down, then we're up, then we're down. We don't want to see that. We want to see 3 red bars in a row and ideally consecutive lower highs and lower lows, okay? Key criteria number 2. This one is very important. We want to make sure that the 20-day moving average is trending higher and under price, okay? I can't emphasize this enough, guys. I keep talking about the 20-day moving average because it is extremely important, especially for this setup, okay? We want it to be trending and under price. And you guys are actually going to notice that price tends to retrace and it tends to pull back right into the 20-day moving average. Okay. Key criteria number 3, we have to look at the retracement of the pullback. The retracement is the amount that a stock pulls back, right? It's the measure of the amount, or the, I guess you could say the amount of the pullback, or how large the pullback is. That's what the retracement is. And we want to be looking for a 40 to 60% retracement of the prior rally. Meaning, let's say from the lows of this rally to the highs of this rally, that makes up 100%. We want this pullback to be in the 40 to 60% region of this rally, right? So let's see. I would say this is about 60%. I would say this pullback to around the 60% point, right? So in general, you want it to be in this area right here. That's between, I would say, 40 to 60% of this rally, with 50% being around right here. Okay. And the whole point of this is you don't want a really deep retracement, right? Like, let's say after this rally, you retrace all the way down here. That shows weakness, right? If we're really that bullish, if we're in an uptrend, if there's a lot of buying pressure, why would we retrace all the way back to close to the lows of the rally? That shows a lot of weakness. Furthermore, if we retrace under 40% retracement, meaning we retrace to only right here, well, that shows lack of price correction, because we're still going to have significant distance between price and the 20-day moving average, right? So we want to have that golden spot of 40 to 60% retracement of the prior rally, okay? Hopefully that makes sense. Key criteria number 4, let's talk about the entry, stop loss, and targets. So first step is to identify the entry bar and wait for it to completely form. We're going to be discussing entry bars on the next slide, but for right now, this is our entry bar, okay? So as soon as this entry bar has finished forming, what we're gonna do is place our entry above the entry bar's high, right? Like, that's the whole point of the entry bar. This is where we base our entry off of. You wanna put it over the entry bar's high, and you wanna put the stop loss under the entry bar's low, or under the rising 20-day moving average, okay? So basically, once this bar is finished forming and the buy setup, like you see that there's a buy setup, you're going to want to just place your entry right above the highs of this bar and place your stop loss once you're in the position under the lows of that candle. So you would be entering during this green bar as soon as it hits this entry, and you would enjoy the move higher. Okay, and your target 1 is the previous high, right? So we rally, we make a high, right? This is a pivot high because we start pulling back. And our first target is the previous high, because this previous high is now resistance, right? We go up and we drop. This now becomes resistance, so it acts as the first target, okay? So let's talk about entry bars. The ideal entry bars that you want to see at the end of a pullback look like this. They're either narrow range bars or they're small bottoming tails. We want to see small bars, right? Either small narrow range bars or small bottoming tails. And this is where, really understanding the types of candlesticks that exist, this is where it becomes really important. So if you still don't know what a narrow range bar is or what a bottoming tail is, take a step back and go back to the reading candlesticks section of the course. So after a pullback, we always want to see one of these entry bars because it enhances the buy setup, okay? Excuse me. So let's understand why. When looking at these two pullbacks, which one of these pullbacks is much higher in quality in terms of reward versus risk? Which one is better in terms of reward versus risk? This one or this one? And if you're looking at this one, well, obviously this is the correct answer. The reason this is a better pullback than this one is because, first, the bars are becoming continuously smaller. That's another thing we want to see. If the bars are becoming, right, these are red bars. If they're becoming continuously smaller, well, what does that mean? If the red bars are becoming smaller, that means the selling pressure is diminishing, right? Remember, we're trying to play long. We want the selling pressure to diminish. The other thing is we also have an entry bar. You can see this is a kind of like a doji bar, very, very small bar, okay? We can see that the selling is weakening, and we have a clear entry bar. In this case, the selling is not weakening. We have 3 large bars in a row, and we don't have an entry bar, right? There's no clean entry for us to actually go into the buy setup. So let's understand why we want entry bars. And this, once again, guys, is going to touch up on the reward versus risk aspect of this setup. And like I said with the base breakout video, later in the course, when you're looking at my risk management and my share sizing videos, make sure after you watch those, you come back to this section of the buy setup, and it'll give you a lot more perspective. It'll help you understand what I'm talking about here. But I think if you guys went through the base breakout, understanding everything, you guys should be good for this. So entry bars improve your reward to risk. Why? Well, with an entry bar, we have a tighter stop loss. And just like the base breakout video, with a tighter stop loss, we have a higher reward to risk ratio. This is why we want small entry bars, right? So let's understand this. Remember, our entry is always over the entry bar. Our stop loss is always under the entry bar, right? We talked about this here. Once we get this bar by the 20-day moving average, our entry is over it, our stop loss is under it. So in this pullback, we have an entry bar. In this pullback, we don't have an entry bar. So what do? So in this case, in both of these setups, our stop loss is under the lows. Under the lows, it's 590, is 590. In this setup, we have the entry bar. So remember, our entry is above the entry bar's high. So it's at $6, meaning after this bar has completed forming, we're going to be entering during this green bar. And as soon as it hits the highs of this entry bar, that's when we're going to be entering and enjoying this move higher. In this case, we have a very, we actually have an entry bar. So our entry is at $6. However, in this case, our entry has to be over this candle because we don't have an entry bar. So in this case, we have a larger entry. It's at $6.20 compared to $6. Our targets in both of these scenarios is $6.50. Right? So our stop losses are the same, our targets are the same. However, because we have an entry bar here, we actually have a clear entry price compared to this one. So in this case, we are risking 10 cents, right? Because that's the size of our stop, $6 minus 590. We're risking 10 cents, meaning if you enter here and it drops to 590, you're out of the position. It hits your stop loss, it hits your risk, you're out of the position, right? You're risking 10 cents. In this case, if you enter at 620 and it goes all the way to your stop loss at 590, that's 30 cents. So, right, because 620 minus 590 is 30 cents. So we're risking in this scenario 10 cents to make 50 cents because our target is at 650, our entry is at 6. We're risking 10 cents to make 50 cents. In this scenario, we're risking 30 cents to make 30 cents. I don't know why this says 20. It should say 30. So you could see that even though we have the same exact risk, because we actually have an entry bar here, we end up having a tighter stop loss. Because we have a tighter stop loss, we have a higher reward to risk because we're only risking 10 cents to make 50. While in this case, we don't have an entry bar, we don't have a clear entry, we're risking 30 cents to make 30 cents. Why would you risk $100, let's say, to make $100, where in this case, you're risking $100 to make $500, okay? Hopefully that makes sense. Now, let's look at some examples. So right here, we hit the 200-day moving average, which is acting as resistance for the stock. We drop to look at this, the rising 20-day moving average that is under price. You could see that The 20-day moving average is halting prices from continuing lower. It's rising, it's rising. We get a rally, and boom, we begin to retrace. And we have 3 red bars in a row. We have 1, 2, 3, 4 red bars in a row. It retraces into the rising 20-day moving average, so that's check. It's also retracing into the flat 200, so that's a bonus. We have a 40, I believe, this is probably like a 50% retracement, right? If it rallied here, pulled back to here, that's probably 50% retracement, I'd say. Right, so that's a check. There's consecutive lower highs, there's consecutive red bars, perfect. And we have a bunch of entry bars here, right? We have a bottoming tail, then doji bar, then another bottoming tail, and 2 other very small bars. So we have a bunch of entry bars here. Whenever you get into this situation, just put your stop loss under the absolute lows, right? So this is the absolute lows of all these bars. Put it at the lows. So your stop loss would go here, your entry would be over this bar, and boom, what a move higher. Okay. Let's look at another example. We have a rising 20-day moving average, check. We have a nice rally, okay? We have 3 consecutive red bars in a row, check. We have 3 consecutive lower highs in a row, check. Let's see. This is probably a 50% retracement, right, of this rally, check. Into the rising 20-day moving average, good. Then we get a doji bar / bottoming tail. Check. Very good entry bar. Stop loss would be under this candlestick. Entry would be over this candlestick. And you would be entering during this green bar as soon as it hits the entry over that doji candle. And boom, nice move higher. Our target is right here. Let's look at another example of this buy setup. We have a rally. It's kind of a deep pullback, but given the overall context of the uptrend, it's not a big deal. We have a rising 20-day moving average, great. We have a really tight entry bar, really small entry bar, perfect. And look at that move, beautiful. We also have, 2 red bars in a row. Unfortunately it's 2, or maybe this might be a red bar as well, but it's not gonna be perfect every time. Sometimes there's gonna be bits and pieces missing, but it's important to look at the overall context of what's happening. So beautiful buy setup here. Same thing here. We rally, we retrace around, I'd say like 45%, rising 20-day moving average. Nice, it's not a perfect candle, but it's a nice smaller candlestick we can base our entry off of. And boom, what a nice rally. Entry would be over, stop loss under. And check this out, guys. I believe this is the NASDAQ ETF, the QQQ. You could see that, these are all buy setups. You could see we have a rising 20-day moving average. We have a flat 200 that's under price. Every time price touches the rising 20-day moving average, we go up. So you guys are starting to see how we are combining different elements that we are learning. We are combining our knowledge. We know that when the 20-day moving average is rising and trending higher, price tends to retrace back to it, right? Price goes up and retraces back to it. Price goes up and retraces back to it. Goes up, retraces back to it. You guys get the idea. And we're combining our knowledge of how to use the 20-day moving average with the buy setup, with, the 40 to 60% retracement, with the lower consecutive red bars, with the consecutive lower highs, with the entry bars, right? We're combining all of this information to produce a very potent setup, okay? We looked at this example earlier. Take a look at this. We rally. We have a rising 20-day moving average right here. Nice doji bar. We rally. We actually end up kind of basing and then retracing back. Another buy setup. Boom, boom, bam. And what we have to understand, guys, not every buy setup is going to be perfect. You're not always going to get exactly what we talked about in this class. However, just look at the overall context of what's going on. This is not a perfect setup. We had a bit more retracement than we wanted to. However, given that it's also retracing to the prior support, it's in a really strong uptrend. We have a really nice rising 20. It looks like a nice setup, okay? So not every buy setup is going to be perfect. You have to look at the overall situation, the overall context. You have to look at multiple time frames, okay? And yeah, make sure you take advantage of the setup, guys. And make sure you really understand everything we talked about today. Okay? You can't have missing parts, right? And I'm trying to think of anything else I want to emphasize here. Something I really want to emphasize actually is play with the trend. Okay? If we're in an uptrend and several time frames are telling you that this is bullish, we're in an uptrend. On several time frames, we have rising 20-day moving averages that are trending under price, right? Let's say that's happening on several time frames. All the time frames are telling you that it's bullish, that there's buying pressure, right? Then look for buy setups. Don't look for buy setups if we are in a downtrend, if there's a lot of selling pressure, if we have conflict on the time frames where one conflict says bullish, one time frame says bullish, one time frame says bearish, right? One time frame is sideways. Don't play a buy setup in those conditions. Play a buy setup when everything looks bullish, when we have a clear uptrend. Okay. Hope that makes sense, guys. Thanks for the class. And we're going to be talking about the sell setup in the next class, which is the exact opposite of the buy setup.
Buying the dip is by far one of the most popular strategies in trading, yet over 90% of traders have no idea what to look for when it comes to buying the dip. And frankly, most of those traders lose money trading this simple strategy. And in this video, I want to teach you the exact criteria that you want to look for when it comes to buying the dip. And I'm going to teach you how to differentiate between a high quality dip opportunity and a low quality dip opportunity that's just going to continue to trend against you. And this could be applied for day trading. It could be applied for swing trading, for core trading. This could even be applied for long-term investing, where if you like to dollar cost average into your retirement account or into your long-term portfolio, you could still apply this strategy, especially when you're DCAing into the market or your favorite indexes. This could also be applied for stocks, for crypto, for futures, for options, for Forex. So make sure you pay attention. Make sure you watch until the end of this video, because this is something that I've been trading for over 5 years. This is one of my core strategies, and I buy the dip. I trade the retracement setup almost every single day. And the first thing that you need to understand before I dive into this strategy is the idea and the theory behind price correction. And the best way that I could explain this is, imagine that you just ran a marathon. You just ran 26 miles in the New York Marathon and you are tired. You just finished the marathon, right? Are you going to be able to run another marathon? Are you going to be able to, finish that marathon, run the 26 miles, and then immediately run another marathon? Well, unless you're David Goggins, unless you're superhuman, obviously not. You're going to need to hydrate. You're going to need to sleep. You're going to need to rest. You got to drink some water. You got to go home. You got to, visit the doctor. Maybe you have some injuries, right? You can't just run 2 consecutive marathons. You need a resting period. Well, the markets work in a very similar way, where let's say the market puts in a massive rally. The market just ran a marathon to the upside, right? The market can't just continue higher and higher and higher to infinity. No, the markets and stocks, they need a resting period. They need to correct in price. And there's 2 ways in which prices can correct. There's two ways in which prices can rest. The first way is through a consolidation, where the markets run a marathon, prices are moving up, everything is mooning, and then the markets rest and they consolidate, they base, and they rest until that stock or the market is ready to run the next marathon. And this is a way in which prices can correct, through literally resting and just consolidating. And this strategy is called the breakout. And this is one of my core strategies as well. I actually teach this strategy on this YouTube channel in a different video. So I would highly recommend watching that video as well. But the other way in which prices can rest or correct is through price action in the form of a retracement, where the markets run a marathon, they move up, buyers are buying, buyers are stepping up to the plate. And then once the market or the stock runs a marathon, it needs to cool off. It needs to have a resting period, a correction period. And one of the ways that could happen is through literally a retracement, through a dip. And this happens because buyers from down here are taking profits. Maybe there's even some short sellers that think prices have topped and they're shorting, which is causing downward pressure. But I would say it's mostly buyers taking profits. So the markets can rest, the markets can breathe before they're ready to move up again and run the next marathon, so to speak. So a retracement is a temporary pullback before the trend resumes. And you can think of this as the market breathing. The market is resting before the next leg higher. Because if the markets are just going up and up and up and up and up, that trend is unsustainable. Nothing can just go up forever. In the same way, nothing can go down forever. There needs to be a period of price correction. And if you really think about it, this strategy is really you just trading the continuation of an established trend. Remember, the trend is your friend. I see so many traders who gravitate towards taking reversals, especially beginners. Why? And to really paint the picture here, imagine you're driving your car on the highway. Do you want to be driving in the direction of traffic, or do you want to be driving against traffic? Well, I don't know about you, but I don't want to crash head on into another car. I want to trade in the direction of traffic. Yet most traders want to, drive against traffic, right? In the same way they want to trade against the trend. It is far easier trading with the trend, especially if you're a beginner. I'm not saying don't take reversals. I'm not saying you shouldn't have a reversal strategy in your plan. I do. I actually like taking reversals. I don't usually gravitate towards them, but I do have a reversal strategy within my trading plan. However, I always prefer to trade with the trend because it's much easier. So if the trend is your friend, what is the first step when it comes to trading the retracement setup? Well, the first step is you need an uptrend or clear bullish momentum. You need to be confident that prices are going higher. I want to be trading in the direction of the trend. If there is a downtrend, I don't want to be going long. If there's a sideways trend, I also, most of the time, don't want to be going long. I only want to go long when I'm confident what the trend is. So what is an uptrend? And most of you are already going to know this. It's very simple. And by the way, if you can't tell, I like to keep my trading as simple as possible. That's what makes me a profitable trader. I don't like to use complicated indicators. I don't like to use complex strategies. I trade essentially 2 to 3 core strategies. Number 1, the retracement setup. Number 2, the breakout or the breakdown. And I also like to trade reversals at times. However, I would say 90% of the time, I am trading in the direction of the trend through either a retracement, aka buying the dip, or through a breakout. So what is an uptrend? An uptrend, it's very simple. Higher highs, higher lows. Okay, that's all you need to know. All right, we have higher highs right here, right here, right here, and we have higher lows right here. We know that the overall direction is moving higher. Now, your goal as a trader is to essentially time your entries when this dip happens. This is when you obviously want to be getting into the trend. You don't want to be getting into the trend here. Most people actually FOMO here because they think they're missing out just to see that stock move down. They sell here, it starts to move up again, then they buy either here or here just to see it move down, they sell, and then the cycle repeats. And that's how most retail traders unfortunately trade. They buy the top and then they sell the low of the retracement when it should be the opposite. They should be buying the retracement and then of course selling this point right here. Or maybe you're going for a much larger move. Maybe you're swing trading, or maybe you're holding your trade intraday when you're day trading for like a few hours and you're aiming for a much bigger gain. You could actually buy down here and then hold through all of these dips in attempt to catch a much bigger move. But you need an uptrend. If you don't have an uptrend, you need clear bullish momentum. And one of the ways that I like to see clear bullish momentum is through a bullish gap up. So what is a gap? A gap is an overnight change in price. This is when a stock opens the next day at a different price in which it closed the previous day. So let's say Tuesday, 4 p.m. Eastern, when the market closes, the stock closes at $5. And then the next morning, Wednesday at 9:30 a.m. Eastern, when the market reopens, that stock opens at $10. That difference in price that occurred overnight is called a gap. And I like to trade the continuation of a bullish gap up. And a bullish gap up gives me bullish momentum. It gives me a bullish bias. So lots of my retracement setups actually occur on bullish gap ups. And I'm going to show you a bunch of examples of that. But here's an example of a gap up. This was on plug. Oh, no, I'm sorry. This was on open, I believe, just a few weeks ago. And this stock closed right here the previous day. And then the next day it opened 29% higher right here. You could literally see the gap in price. You could see this overnight change in price. And of course, the stock absolutely mooned that day. And there was a beautiful retracement setup on this day, which I'm going to show you a little bit later in this video. But this was a gap up that gave this stock clear bullish momentum. We were gapping above resistance. We were also gapping above 2 red bars, which trapped all of the sellers who went short here or here or here. So really amazing gap up. I have other videos that go a lot more in depth when it comes to explaining gaps, but this was a really nice gap up that obviously continued higher. Here's another example. This was on RUM just a couple of days ago. I will also show you this example later in the video, but it gapped from here the previous day and it opened right here, which was an around 11% gap up. All right, and this actually also had a retracement setup. It had a buy the dip opportunity on this day, but this gap up gave this stock a bullish bias. And my bias on this day was to go long. So I was looking for either a breakout or a retracement setup to essentially trade this bias on the intraday timeframes. If that still sounds a little confusing, we're going to be looking at a ton of different examples later on in this video. But essentially my point is I need either an established uptrend or I need a bullish bias. I need bullish momentum. And one of the ways I could see, bullish momentum is through a bullish gap up, a bullish overnight change in price to the upside. So when it comes to identifying a high quality dip buying opportunity, we look for specific pullback criteria. And let's go ahead and go over every single one of these pullback criteria. And from there, we're going to go to real charts and apply everything that I have just taught you. Okay, so I'm going to go through this section a little bit quicker. We're not going to be looking at examples right away. I want to show you all of the material first, and that's when we're going to go and look at examples and apply everything that you've just learned. So first step, following a rally higher, so the market ran a marathon up, we want 3 or more consecutive red bars in a row on the pullback. So we got 1, 2, 3, 4. We want 3 or more red bars in a row. Now, this is like the ideal scenario. You're not always going to get perfectly 3 to 5 consecutive red bars in a row, but this is what you want to look for. You want to see 3 or more consecutive red bars in a row. Why is that important? It's important to know that because you don't want to see Christmas lights. What are Christmas lights? Red, green, red, green, red, green, red, green, and then you move up. You don't want to see this. And the reason you don't want to see this is because as prices start to move up, if you have green bars within this pullback, well, a lot of those buyers, like think about it. If you bought it right here and then prices continued lower and now you're down on your position and then all of a sudden prices start moving back up, you might feel the need to actually just cut that trade because you felt wrong and you were losing money, right? Or if you, especially if you bought it up here and then prices continued lower, if prices move back up, well, at that point, you might just cut your losses or you might just say, hey, this was a failed trade. I'm going to get out break even. And you're going to have almost like layered buyers within this pullback, and you don't want that. You want there to be clear selling. Okay, you just want the sellers to be taking profits before the next move up. You don't want selling and then a little bit of buying and then selling and then buying and then selling and then buying. You don't want Christmas lights, because these layered buyers could actually put sell pressure on this stock as it's moving up, where as it's moving up, these buyers sell, then these buyers sell, and then all of a sudden you have a really choppy kind of next move higher. You don't want that. You want 3 or more consecutive red bars in a row. You don't want Christmas lights. Criteria number 3, you want to look for prices to retrace into the 20-period simple moving average. I like to keep my trading as simple as possible. I don't use complicated indicators. I don't use MACD or Bollinger Bands or RSI or VWAP or stochastics or Elliott wave theory or Fibonacci. I don't use any of that. I keep my trading very simple. I only use 2 simple moving averages and volume. That is it. And the 20-period simple moving average is the ultimate trend following tool in existence. Now, pay attention to what I just said. Trend following tool. That is our first step for trading the retracement. Is we want to have an uptrend. We want to have an established trend higher. And that's exactly why I like to use the 20 MA. Now, what we want to look for is we want the 20 MA to be underpriced, trending higher. I want you to say that out loud. You're watching this YouTube video. I want you to literally say it with me. Underpriced, trending higher, underpriced, trending higher, underpriced, trending higher. We want the 20 MA to be underpriced, trending higher. And we want to be timing our entries when prices are close to or near the 20 MA. That's what we're looking for. When prices are, let's say, really far from the 20 MA, that means there's extension. Extension is the distance between price and the 20 MA. We don't want to be entering when there's a lot of extension. So you could use the 20 MA to figure out whether prices have corrected enough, whether prices are extended, or you could think of it as overbought. So the closer we are to the 20 MA, the less extended we are, the less overbought we are. And that's why we want to be timing our entries when prices are near the 20 MA. And let me show you an example. It's going to be a lot easier when you actually just visualize this. Take a look at this uptrend. Take a look at every single retracement setup here. This is the 20 MA, the blue line. What is it doing? It's underpriced, trending higher. It's not flat. When the 20 MA is flat, it's not effective. That suggests that prices are trendless, that their prices are sideways. We want it to be underpriced, trending higher. And notice, every time we got close or we touched the 20 MA, we bounced. And that was honestly a very good dip buying opportunity. Literally every time it hit the 20 MA, every single retracement here, 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 here. You get the idea. Every single retracement got bought. And this is exactly why I like to use the 20 MA in conjunction with everything else that I'm going to teach you in this video. Whenever I teach the 20 MA, people are like, oh, well, you're just using an indicator for your entries. No, I use it as a complement. It complements every other part of my analysis. It complements the other criteria. I use it to my advantage. I don't solely rely off of it. Here's another example of a downtrend. We base into the 20 MA, drop. Base into the 20 MA right here, drop. Retrace a little bit, we come a little close, drop, okay? That's why I like to use the 20 MA. Here's another example. And we weren't quite, right at the 20, but we're pretty near the 20. And this was actually on the 15-minute time frame. On the 5-minute time frame on this chart, we were actually right by the 20. But this was an excellent buy the dip opportunity where we moved up, retraced, and that was an excellent buying, buy the dip setup. So we want the 20 MA to be underpriced, trending higher, and we want to see prices retrace into the 20 MA or at least come close to the 20 MA. This is a very important requirement. Criteria number 4 is actually pretty simple. we want to see the stock retrace 40 to 60% of the prior move. We want it to pull back 40 to 60% of the original rally. Retracement, if you want to define what a retracement is, it's just the amount that the stock pulls back. So we want to see this pull back into what I call the golden zone. And that is between 40 to 60% of this rally, right? So let's say this was 0%, the bottom of the rally. This was the top of the rally. That represents 100%. We want it to pull back around 40 to 60% of this rally, which is like this area right here. We don't want it to pull back deeper than 60%. We don't want it in this area right here because a deep pullback suggests weakness. If that stock was really that strong, if that trend was really that established and really that strong to the upside, why would it retrace over 60%? And the same thing applies almost in the opposite way if it's under 40%. So let's say a stock pulls back here, right, into this area. That shows lack of correction. And, just through my experience, when you have a very shallow retracement where it's not into this golden zone, where it's like 20% retracement or 30% retracement, whenever it attempts to move higher, it fails because it just hasn't corrected enough. It hasn't gone through enough of a resting period for prices to continue higher. And similarly, if you see a really deep pullback into this area, well, prices are really weak. And what tends to happen is it starts to move up, you get excited, and then it fails. And that's just through my personal experience. You want to see it into the golden zone, the 40 to 60% retracement of this prior move. That's really the sweet spot. Criteria number 5. Before I enter into any single trade in the markets, I need a predetermined entry, predetermined stop loss, and of course, predetermined target, because that's going to add structure to my trading. I hate operating randomly. I want to know where I'm supposed to get in and where I'm supposed to get out if the trade doesn't go in my favor. A lot of traders operate completely randomly and then they expect consistent results. That makes no sense. If you want consistent results, you need consistent input. That means you need a structured approach towards entering and exiting a trade. So the entry and the stop loss for the retracement setup is actually really simple. So your entry is going to go over the last candlestick of the pullback. I'm going to show you what that looks like in a second. Your stop loss is going to go under the lows of the retracement. So you find the lowest point of the retracement. Your stop loss is going to go below it. And the target is the previous high. So where are the last candlesticks of the pullback? Well, right here, these two. So entry over these two candlesticks, stop loss below the lows of the retracement, and you're going to be targeting the previous high. That is target number 1. Now, that's super simple. And ideally, you want your entry bars, right here. These are our entry bars because we're using these bars to base our entry and stop loss off of. We want these to be narrow range bars or doji bars. We want these to be relatively small candlesticks. And the reason we want that is because it's going to give us a far better reward to risk. So how do you size your position? If you watched my risk management video, you should already know this, or if you've watched my free 10+ hour course, you should know this. The share sizing formula is risk divided by entry minus stop loss, and then entry and stop loss, they're in parentheses. So you calculate this first before you do the division. So let's say our entry is at $4, stop loss is at $3.90, and our risk is $100. $100 divided by $4 minus $3.90. So that's $100 divided by 10 cents. $100 divided by 10 cents is 1,000 shares. So that would be our share size for this position. If we get 1,000 shares at $4 and it hits our stop loss at $3.90, we would lose $100. All right. Now, why do we want small candlesticks? Well, let me give you this example. Let's say this is a really large candlestick like that. Let's say these candlesticks are larger. And then all of a sudden we have a much bigger stop where instead of our stop being at 390, let's say our stop is at 370 all of a sudden. Then we have to go and actually change the formula around because our entry remains the same, right? But our stop loss is different. So instead of 390, this would be 370. So now our share sizing formula would be $100 divided by 30 cents, because $4 minus 370, that's the distance between our entry and our stop, 30 cents, right? So $100 divided by 30 cents, that means we would only be able to get 333 shares for this position because we have a much bigger stop loss, and therefore we have a much lower R to R. So we want smaller candlesticks, we want smaller entry bars so we can get a tighter stop, and as a result we could have a better reward to risk for, our same risk. Keep in mind, with having a 30-cent stop now versus a 10-cent stop before, our risk hasn't changed. What's changed is the amount of shares that we can get, so that, if the trade does hit our stop loss, right, we're only going to lose $100. So we want smaller entry bars because we have a better R to R. Criteria number 6, we want to look for a retracement into what's called minor support. This is when prior resistance of that uptrend becomes support for the next dip. So, for example, let's say we are right here and prices move up. Fantastic. We want to see this next dip basically dip into the prior resistance, right? Like at this point right here, this prior high, it's going to act as resistance. That's why this prior high is target 1, because that's the next level of resistance. But on this dip, we want to see this prior resistance, this area of resistance, become support. And this is a really nice amplifier where if we could have a nice move up and then a dip into what was before resistance, that's exactly what we want to see. This is a really solid area to potentially buy the dip for the next move higher. So if I draw it out, we have an uptrend, right? We have an uptrend. This is an area of resistance. We want this area of resistance to now become support, and it moves up. Same thing here. This area of resistance, okay, right here, now becomes support for the next dip before we move up. And this is a really nice amplifier, and it's really simple. Prior resistance, the prior high, basically becomes support for this stock within the uptrend. Now, before I show you some real life examples and some recent trades that I have taken where I was trading the retracement setup, I want to emphasize that you don't need every single one of these criteria to hit in order to buy the dip. And that somehow rhymed, but you don't need every single one of these qualities, right? You can pick and choose which qualities you want to put into your trading plan. For example, let's say I'm looking at a retracement setup and it's into the golden zone. Great. It's into a rising 20. Great. It has 3 or 4 red bars in a row. Fantastic. It has a nice entry. It has a really good reward to risk, but it's not retracing into minor support. I will still probably take that trade because it hit enough of my criteria. Let's say instead maybe it did retrace into minor support, but it's not quite into the golden zone. Maybe it's like right here, like 65% retracement, but it's into the rising 20. It has a really bullish catalyst. It has 3 or more red bars in a row. It has a really nice R to R. I might still take that trade, right? So you could pick and choose which criteria you want to specifically focus on your setups, because you're not always going to get picture perfect retracement setups. If you do, great, you should just take it, but you're not always going to get picture perfect. So you can decide which one of these qualities you want to include in your game plan, and you can decide which one of these qualities are like necessities versus maybe some of these are more optional for you. So right off the bat, I want to show you what a power trend is first and how you can capitalize trading retracements within a power trend. And a power trend is exactly what it sounds like. It's a powerful trend. And most of the time you're going to see the 20 SMA under prices trending higher, and you will see it kind of trending in a 45-degree angle. When you see the 20 MA trending in a 45-degree angle, it suggests that the trend is sustainable. When you see it trending at a little bit, greater than a 45-degree angle, that's when the trend is kind of getting exhausted. And you could see this was on Wayfair just recently over the last few weeks. I mean, look at this beautiful uptrend. Every time it retraced to the 20-period moving average, literally every single time, it respected the 20 MA and then started to rally right after that. Even here, we broke below the 20, instantly rejected and continued higher. Even here, almost broke below the 20, instantly rejected and continued higher. Here's another really good example of that going both ways. Here we have a solid power trend to the downside where we dropped, retraced to the 20 MA, dropped, retraced to the 20 MA. And this is also, a retracement setup just to the downside. So everything that I taught you in this video could also be applied if you're going short. You would just apply it the opposite way where the 20 MA is overpriced, trending lower. And all of the same criteria would apply the same exact way. So retrace to the 20 MA, dropped, retrace to the 20 MA. This time it gapped down all the way to the 200, respected it, right? Retrace back to the 20, dropped, retrace back to the 20, dropped. And then the same thing happened on this uptrend. You could see how well prices are respecting the 20 MA on this power uptrend. And every time we got a retracement to the 20 MA, we ended up rallying. We could even look at the S&P 500, which has basically been on a power uptrend since the tariffs happened in early April, and we've rallied 36% since then. And take a look on this uptrend, every single dip into this rising 20 MA got bought. We dipped right here, right to the 20, instantly moved up. Dipped into the 20, moved up. Dipped into the 20, moved up. Even here, we broke below the 20, instantly rejected, continued higher. Dipped right into the 20, perfectly respected it. Same thing here, same thing on this tail, same thing recently here. So if you're noticing that you're looking at a stock or any type of asset that is power trending and closely following the 20 SMA, you could actually use every dip into the 20 SMA as a buying opportunity, especially if it matches up with the other criteria that I have taught you. Let's look at some individual retracement setups that we can understand and analyze. So the first one is Plug. We already looked at this gap earlier in the video, but this gap from 284 the previous day, and it opened around 13% higher at 321 the next day. It was gapping above a red bar, and it was also gapping above resistance. So this was a really bullish gap, and this gave me a bullish bias for the day on Plug. From there, we go to the smaller time frame. So I like to use the 5-minute chart, especially around 30 minutes into the day. And funny enough, I will be honest, I actually got stopped out on Plug because I originally tried it as a breakout here. I was super aggressive. It was extended from the 20 MA, so really aggressive setup, and I took a full stop on this. And funny enough, right after that, I called this as a retracement setup, and I had a lot of my students actually take this play and make money, but I ended up passing on it. And then looking back at it, it was just a beautiful retracement by the dip opportunity, but I already kind of took a stop on this, so I stopped watching the Plug and I started focusing on other stocks. But wow, what a setup here. Really nice pullback. We had 3 or more red bars in a row. We did have one doji, but it's never going to be exactly perfect. So nice pullback into the rising 20 MA. I would call this a 40 to 60% retracement, right? Maybe 60%, 55%, something like that. But we're into that golden zone. Perfect. We had a gap up, so we can't really look at minor support. So, that criteria doesn't really apply. And the entry would go over these candlesticks, over 345, stop loss around 335. So it was a 10-cent stop, and this ended up moving all the way to 392, which is around a 40 to 50 cent gain. So this was like a 4 to 5 hour trade, it would have been. And maybe you took profits at target 1, and then you left a runner, and maybe you took those profits somewhere up here, but really nice retracement setup. And obviously I didn't take advantage of this, but I had a ton of students who did. And yeah, this is a really great example of a bullish gap on the daily time frame, and then you trade that bias via a retracement setup on the intraday time frames. Let's look at another example, and this was on Rumble, and this was also just a few days ago. This was just this past Friday. This was the same day that the plug happened, and I know that because I actually called this trade in my group, and this stock gapped from 739 to 823, which was an 11% gap up. So that gave me a bullish bias for the day because we were gapping above this resistance. And the next major resistance was honestly the 200 period simple moving average. So I thought that this stock could actually run up to around $9 for that day. And I go to the 5-minute time frame, and we'll look at the other time frames in just a second here, but we get a beautiful retracement setup. We get a nice move up, 4 red bars in a row. Perfect. We don't see any Christmas lights. We are kind of far away from the 20, but you got to keep in mind, because of the big gap up, it's going to take time for the 20 MA to catch up to prices, but it's still rising. It's still under price. And the entry would be over this red bar, stop loss directly below. And we would enter this trade basically as this green bar is forming. We don't wait for this green bar to finish forming and then take it. As soon as it hits above this entry, above, what was it, 833, we would get into the trade. So you don't need to wait for this green bar to actually finish forming. And this was kind of a deep retracement, maybe a little bit above 60%, but still really nice retracement setup. And of course, TP1 would have been this prior high. And then TP2 would be the next target, which I said was around $9, and we hit around $8.95 on that setup. If you look at the 15-minute, it looked really, really solid too. So I always like to look for multiple time frame alignment. We had a nice green bar, red bar, and a nice doji bar. I like doji bars, right? So entry above the doji bar, stop loss directly below. So you could have taken this retracement setup also off the 15. And by the way, we kind of got one, later in the day. Even though I didn't really like this one, it was a really deep pullback. But hey, if you wanted to trade this retracement setup right before the close, you could have entered above this little base, above these candlesticks, stop loss directly below. Let's look at the RKLB, Rocket Lab Corporation. This was a few months ago, but I remember taking this trade, and this was just a fantastic retracement setup. We had a very minor gap up from 25.40 to 26.65. So we were just clearing above this resistance. And that small little gap up actually gave me a bullish bias on the day. We were clearing above this resistance, and I thought we had upside to move higher until this prior resistance area. So we go to the 5-minute time frame, all right, and we got a really nice retracement setup here. Green bar, we got one big red bar, then a small little kind of topping tail, narrow range bar, right? So entry above, stop loss below, and obviously this had really nice follow through, but I think this was actually way nicer on the 2-minute time frame. So I always like to look at multiple time frames, and that gives me a lot better of a perspective on what that stock is actually doing. And as you can see on the 2-minute, it was actually much nicer. Nice move up, red bar, bottoming tail, and then we had like 2 doji bars in a row. Really nice. So we didn't see 3 to 5 red bars in a row, but it didn't matter because it was still a really nice retracement setup, entry above, right? Stop loss directly below. And you could have even entered it here. Let's say you missed this setup and moved up kind of based. You could have put your entry here, stop loss directly below. I would say this would be a little bit tougher because it's right into the prior high. But of course, it didn't matter. It continued up, and even here had a nice little retracement setup. Moved up, retraced 3 red bars, bottoming tail. You could even played this. I wouldn't have, and I didn't. But, in theory, this is also a retracement setup. Entry there, stop loss above, and you would have taken profits at the previous target. Let's look at another one, and this was on APLD just a few months ago as well. Terrific trade that I called and actually executed on. And APLD had a nice move up, retracement, almost had a retracement setup here into the rising 20, 4 red bars in a row, and it triggered this retracement setup on a gap. So we gapped up, triggered that setup, and of course we had a really nice follow through to the upside, and I traded it on the day of the gap. So this gap was gapping above those 4 red bars, above resistance. I thought it was really interesting. It gave me a bullish bias on the day, And if we go to the 5-minute time frame, we got, basically a picture perfect, retracement setup. Nice move up, 3 red bars in a row. Then we had a bottoming tail, narrow range bar, close to the 20 MA. Okay, around a 60% retracement or so, a little bit more than that, but still really nice. And entry would have been over that candlestick. Stop loss directly below. And of course it hit target 1. It actually exceeded target. In fact, we kind of got another retracement here and another retracement setup here that you could have played. So really nice setups. And even though it didn't hit every single criteria, it's still an effective setup because we combined the daily time frame and looking at the gap and establishing that bullish bias. We knew that there was a bullish direction, there was a bullish catalyst, and we combined that catalyst with a retracement setup on the intraday time frames. Let's look at some retracement setups that actually work the other way, that actually worked as shorts. So this stock gapped from 2022 to 1888 the next day. So this was like a 6% gap down, but notice how it was gapping below the 200 and below a lot of this resistance. So really bearish gap down. I had a bearish bias for this stock on that day, and we got a picture perfect, almost power trend lower. But take a look at this retracement. We moved down. We had 3 green bars in a row. Remember, we want 3 red bars if we're looking to go long. If we're looking to go short, we want 3 green bars in a row, 40 to 60% retracement into the golden zone, near the 20 MA, so nice. And entry right below these candlesticks, stop loss directly above. And then literally every single time it retraced near to the 20 MA, it actually just continued lower. So beautiful, picture perfect retracement setup. In the opposite direction where we would be going short instead of long. So all the criteria that I just taught you, it would just be the opposite if you're going short. Let's take a look at the FNKO, and I remember this setup very clearly because I couldn't get filled on it, and it was an unbelievable trade, but I couldn't get filled any shares short on my Thinkorswim. I just couldn't get a fill, so I couldn't take advantage of it. But this was gapping from 365 that day to around 298 the next day, around 18% gap down. This stock had a nice move down, based, and it triggered this breakdown via a gap on the daily chart. So I had a bearish bias going into this day. And if we go to the 5-minute time frame, we could see a beautiful, just beautiful retracement setup right here. It's a little bit choppy because TradingView doesn't really represent this data all that well. But we had a nice move down, 40 to 60% retracement, not a perfect retracement, but it was still good enough to take. Near the 20 MA, right? 20 MA was starting to catch up to price. And basically the entry would have gone under 264 or under 265, stop loss 275. And it was a 10-cent stop, and this thing dropped all the way to 232. So unbelievable trade. This was actually scalpable as well. Really nice retracement setup for a short. And in fact, it worked as a retracement here. It retraced to the 20 MA, kind of based, dropped. Retraced to the 20 MA, dropped. But at this point, it formed a higher low. So, that's obviously a red flag, and it obviously started to kind of transition higher after that. But beautiful retracement setup to the downside. Like I said, entry under 265, stop loss 275. And if you look at the 15-minute, look at that. Really nice. Nice move lower. Couple of green bars. We had a doji bar here, and beautiful continuation to the downside. Hopefully you found tremendous value in this video, and I want you to actually test this strategy first in your own trading with either paper trading or really small risk, so you could develop a feel for trading the retracement setup, and you could practice applying all of the criteria that I've taught you today. All right, before you actually use significant risk, I want you to test it out. I want you to kind of develop your own intuition for this setup and be selective with your trades. Don't just take any retracement. I pass on over 95% of the dip opportunities I see in the markets because I only like to go for high quality A+ retracements. So make sure you're paying attention to these criteria and make sure you're practicing this setup before you actually use heavy risk. Let me know in the comments what you think about this strategy and whether you think it's going to be very effective for your trading plan. Make sure you leave a like on this video and make sure you subscribe to the channel for my other education. And lastly, make sure you get started with my free 10+ hour trading course. Like I said, it is genuinely better than most paid courses on the internet, and you're going to find that out, and you're going to learn more about this strategy in my free course as well. So I will see you on the next video. Thank you so much for watching.
What's going on, guys? Hope you're having a great day. We just talked about the buy setup, but now we're going to be talking about the sell setup, which is the exact opposite of the buy setup, except we're going to be shorting instead of going long. So we're not going to spend as much time on the sell setup as we did on the buy setup, since it's exactly the same concept, except, obviously it's the opposite. So let's just get right into it, and we'll do a quick little class here. Sell setup, what is it? It's the opposite of a buy setup. We're going to be shorting the retracement rally, right? So we know how if we have an uptrend, if we have a rally, we have a dip. Same thing when we have a downtrend, right? We drop, we also have a little bit of a retracement rally. It's one of the most potent strategies for day and swing trading. Works in any time frame, stocks, crypto, forex. And it's really important to just develop the skills required to recognize one and recognize when you have a quality sell setup. So guys, same idea here. We drop, we need to correct in some way after this large drop. Maybe some people need to cover their shorts. Maybe some people are buying it down here in hopes that it's bottoming. But we have a retracement rally, right? And this is where we want to time our sell setup. This is when we want to get in, so we enjoy the move lower. And then, of course, we could cover here or stick with the play. And we see we have that retracement rally, and we have another sell setup, and we short it here and enjoy the move lower. Okay, we must have a downtrend in order to play the sell setup. Just like we need an uptrend when we're buying the dip, when we're doing a buy setup, we need an established downtrend when we are trading the sell setup. Guys, don't overthink this. It's the exact same thing, except it's the opposite. Key criteria number one, after a huge drop, we need to have 3 or more consecutive green bars in a row with higher highs and higher lows, right? This high is higher than this high, this high is higher than this high, and this high is higher than that high. Okay, 3 consecutive green bars, and ideally consecutive higher highs and consecutive higher lows. Okay, it's the same exact thing. We are basically analyzing the quality of the retracement. Okay, same thing here, guys. The 20-day moving average requirement. Remember, when we're downtrending, when we're shorting, we want the moving average to be trending lower, and we want it to be overpriced, trending lower and overpriced. So we drop from the 20-day moving average, and then we retrace right back to it here. Okay. Same thing, guys. 40 to 60% retracement. If this retraces too much, then it's clearly too strong, right? We're trying to short. We're looking for weakness. If it rallies all the way up here, then it's clearly not all that weak, because otherwise, if there was really that much selling pressure, the sellers wouldn't allow there to be a retracement to here. Similarly, if we only retrace to right here, there's still extension from the 20-day moving average, and a full correction hasn't been made. So we're looking to the 40 to 60% area. In this case, it's around 50%. Okay, so we drop 40 to 60% retracement. Our entry and stop loss, it's the exact opposite. Once our entry bar has formed, we put our entry under the entry bar. We put our stop loss over the entry bar, since we are shorting. So we would be entering during this red bar when it hits the lows of this entry bar. Okay, and our target is the previous pivot low. Same exact thing, guys, just opposite. Entry bars, as we're aware, it makes it an enhanced setup. Ideally, we have narrow range bars or small topping tails, right? Before, on the buy setup, we wanted bottoming tails, because a bottoming tail shows that the buyers have taken control. With a topping tail, it shows us the sellers have taken control, which is what we want when we're shorting. So we obviously want an entry bar. It improves our reward to risk. Okay, obviously here the green bars are becoming smaller. The buying is weakening compared to this. We have an entry bar here. We don't have an entry bar there. Okay, same thing. And the exact same idea, guys. With an entry bar, we have a tighter stop loss. We have a higher reward to risk. This is why we want entry bars. Stop loss is at $6. Our entry is at $5.90. We're shorting it, remember? Here, our entry is at $5.60. Stop loss at $6. Right? Same target, same stop loss. Different entries because we don't have an entry bar here. And in this case, we're risking 10 cents to make 40 cents. Oh, I'm sorry. We're risking 10 cents to make 50 cents. In this case, we're risking 40 cents to only make 20 cents. Okay, obviously the reward to risk is a lot better here because we have that entry bar, we have a tighter stop loss, and our risk to reward is a lot better. Okay? Okay, guys, let's look at some examples, right? The 20-day moving average is starting to curl over price and is declining now, right? Especially it's curling over. And we have a drop. Then we have a base breakdown here, actually. So we have a drop, base breakdown. We break down, right? Then we have that retracement. We have 3 or more consecutive green bars in a row. We have a topping tail, right? In fact, we have a topping tail and a really nice small entry bar. In this case, guys, I know technically we're supposed to put our stop loss over the entry bars high, but in this case, since the topping tail is higher, we're going to put our stop loss there. Okay, we in general want the stop loss to be over the absolute highs of the sell setup, right? Our entry would be under this bar as this bar is forming. So as soon as it hits the lows, we enter. And the target is a previous low. Beautiful, beautiful sell setup. This is around, I'd say, 60% retracement. So beautiful sell setup. Perfect example of this. And notice how it's right into the declining 20-day moving average. It literally stops at the moving average. This is why the 20-day moving average is so important. Same thing here, guys. The 20-day moving average is dropping. It's trending lower. We have a huge drop. 3 or more consecutive green bars in a row. We have a, kind of larger, a larger entry bar than we want. However, it's still good. Our stop loss is right here, entry right here, and we actually surpass our first target. Notice how it went right to the declining 20-day moving average. That's when we had our drop. And we actually did another one here where we rallied. This is not a perfect sell setup, but still. Entry bar, and we continue lower. Okay? Hopefully that makes sense. We also have higher highs on each of these green bars. Just really, really nice setup. Same thing here. This one's a little sloppy. We have a prior support here that becomes a resistance for the sell setup. We drop. This one's a bit sloppy, entry bar, but nevertheless, it's a sell setup right into the declining 20-day moving average. It kind of went above the 20-day moving average, but that's not a big deal. It's never going to be perfect every time. Okay? Really nice sell setup. And notice this is supposed to say sell setup, but not every sell setup is perfect. You have to look at the overall context of what's happening. And remember, guys, if you're having troubles with this setup, it's exactly like the buy setup. It's just the opposite. You're shorting. You're taking advantage of and making money off the price moving lower. But key idea here is, guys, remember, use the 20-day moving average to your advantage. And once again, you're seeing that we're combining all of these ideas to produce a really potent trading setup that has a high likelihood of success. Okay? By combining different ideas and different elements of what we're learning in this course, we're going to be able to combine everything, right, and find setups that are extremely high quality and have a high likelihood of success and high likelihood of, making money. That's what we're here to do. So hopefully this makes sense, guys. This is basically like buying the dip, except you're shorting the rally, right? So you guys know all the requirements. And something I want to emphasize, just like I did with the buy setup class, is make sure there's an established downtrend. Okay, don't trade the sell setup if you have an uptrend. Don't trade the sell setup if the charts are looking bullish. If the charts are showing buying pressure. Look at several time frames. Look at the daily, right? Look at the hourly. Look at the weekly maybe. Look at the smaller time frames such as the 15, 5, or 1 to 2 minute charts and see what's going on. Are we bearish? Do we have clear selling pressure? Do we have a downtrend? Or do we have conflict on the time frames? Do we have some time frames looking higher, some time frames looking lower, some time frames maybe sideways? You don't want to trade that. You want to trade the sell setup when there's clear bearishness on multiple time frames and when you have established downtrends on multiple time frames. Okay, that's something that's really, really important. And same thing with the base breakout and the base breakdown as well. I didn't really cover it before, but you want to trade the base breakout when you have an established uptrend on several different time frames, when several different time frames are showing that it's bullish. Just like you want to trade the base breakdown when several different time frames are showing bearishness, showing that there's selling pressure. If you guys don't get the idea at this point, definitely go back and watch my multiple time frame analysis video. You guys get the idea here. You want multiple time frames to all be in agreement. And once they are, then you could start finding these setups that we're learning. Okay? Awesome, guys. We have now learned 2 different strategies, right? The buy setup and the breakout, and the respective sell setup and base breakdown. And boom, now you guys are ready to begin trading them. So maybe try to look for some on your charts, try to practice, maybe come to my live streams and ask me questions about whether you found one or not. But perfect. Make sure you guys really understand the requirements that go into the strategy. Anyway, guys, we're going to be discussing the 1, 2, 3 pattern next. See you there. What is going on, guys? Hope you're having a great day. Today, we're going to be talking about another strategy that we're going to add to our trading arsenal. We already talked about the breakout/breakdown and the buy setup and sell setup, but today we're going to be talking about another type of strategy. And the best way to sum up this strategy, it's a continuation play, okay? So we already discussed and looked at a diagram showing how price corrections occur and how we take advantage of price corrections through either buying, after a base, or through buying a pullback, or shorting a base or shorting a retracement. Okay, but let's talk about what happens if, let's say, you miss the initial breakout or you miss the buy setup, right? So let's say we have a breakout, or let's say we have a rally first, and then we get a base, we get a consolidation, and of course we're looking to play the breakout, right? And similarly, let's say we have a rally, and then we get that price correction and we get a pullback. Okay, so what happens if you miss this initial breakout and you miss this initial buy setup, right? Let's say maybe you weren't at your trading desk, maybe you're coming late to the party and you weren't able to catch the initial breakout. Okay, the initial breakout here, or the buy setup here, right? What do you do, right? Maybe you still want to take advantage of the play, and you may ask yourself, okay, I missed the initial entry. Is there any way I could get into this position through a secondary entry? Okay, right? So maybe you missed this initial breakout, but you get another opportunity here before it inevitably continues higher. Or maybe you get an opportunity right here to get in before it continues higher, right? So the whole point of this setup is to talk about the 1, 2, 3 pattern. That's what it's called, and it's a continuation play. This setup is basically trying to catch the continuation of the move. It's a secondary entry, okay? So let's get right into what it looks like, okay? So the first requirement that you need for the 1, 2, 3 pattern is a bullish 1, 2, 3 pattern, right? Where we're actually going to go long is we need a bullish wide range igniting bar first, right? So remember we talked about what an igniting bar is. Okay, so we need a bullish wide range igniting bar. We don't want to see a large candle up here, right? Or I mean a large wick. We don't want to see a large wick or tail on this bullish igniting bar. And this igniting bar, the reason it's called an igniting bar is that it ignites the move higher, right? This is the first bar that is igniting the next move. So it's going to indicate the direction of the move. In this case, it's higher, right? Shouldn't have a significant topping tail. We talked about that. And the next bar we have here is a resting bar. And this resting bar, it's usually a narrow range bar or sometimes a doji candle, okay? And this resting bar has to form and stay in the top 33% of the igniting bar, meaning it has to be ideally in the top third of this candlestick. You're not always going to see that. Sometimes the resting bar is a little larger. It's not a big deal if that's the case, but ideally, if we're just talking about the textbook version of this pattern, you want to have a resting bar that's in the top 33% of this igniting bar. You could see this one is, in the top third of this bar. It doesn't matter if it's green or red or if it's a doji candle, that doesn't matter. And ideally, you want it to form an equal or near equal high with the igniting bar, meaning you want the high of this resting bar to be near the high of this igniting bar, right? In this case, we're kind of near the high, because what it ends up forming is a double top or an area of resistance, okay? And the reason why we want to have an area of resistance is whenever we get the triggering bar, right? This is the bar where we would actually enter this pattern, right? We want the trigger to happen when it breaks that resistance, right? And as soon as it breaks that resistance, that would be confirmation that we're going to go higher, and that's when we enter. So you're entering above the highs of the igniting bar and the resting bar, whichever one is higher, right? So if it's equal highs between these two bars, great. But let's say in this case, the igniting bar is a little bit higher than the resting bar, right? You're going to place your entry above the highs of either these two candles. So whichever one is higher, that's where you're going to be placing your entry. And you're going to be placing your stop loss under the low of the resting bar, okay? Or under the low of the triggering bar, whichever one is lower, right? So let's say that there's maybe a large tail, maybe there's a tail here in your triggering bar. You're going to be placing it at the lows. So at the lows of either the resting candle or the lows of the triggering bar. So this isn't really hard stuff, guys. You have an igniting candle, right? Then you get a resting bar, a narrow range bar, or perhaps a doji candle. And right, so it's a 1, 2, and then we're on the third bar. That's where we're going to be that's a triggering bar. That's where we're actually going to be entering and placing our stop. Okay, so let's look at the opposite, the bearish setup, where we're going to actually be shorting the 1, 2, 3 pattern. We first have the wide range igniting bearish bar, ignites the move lower. It indicates the direction of the move. We shouldn't have a significant tail here, right? We shouldn't have a significant bottoming tail, right? When it's a bullish wide range bar, you're not supposed to have large tails, right? So you definitely don't want to have a large bottoming tail here, okay? So that's the igniting bar. The next, we have the resting bar that's forming and staying in the bottom 33% of the igniting bar. So it has to kind of form and stay in the bottom third of this igniting bar. It's not always going to do that. In trading, nothing is ever really, exactly perfect. But ideally, the textbook version, you want to have this resting candle be in the bottom 33% of this igniting bar. It doesn't matter if it's green or red. And ideally, you want it to form near equal or equal lows with the igniting bar, right? You want the low of this bar to be near the equal or near the low of the igniting candle, because that's going to create an area of support. And once that support is broken during the triggering bar, that's where we're placing our entry, right? So the entry is going to be under the igniting bar or under the resting bar, whichever one is lower. So find the absolute low of the igniting bar, the absolute low of the resting bar, whichever one happens to be lower, you're going to place your entry under that, okay? And you're going to short immediately when the bar goes below the lows of the igniting. Resting bar, we just talked about that. Entry, we just talked about that. Stop loss is going to go over the highs of either the resting bar or the triggering bar, whichever one's higher. Usually, it's going to be over the highs of the resting candle. So you're going to place your stop loss over the highs of the resting candle, right? So you have a 1, you have a 2, so you have an igniting 1, a resting 2, and then the third candle is going to be our triggering bar. And the 1, 2, 3, by the way, whether it's bullish or bearish, it could really be played on any time frame. It works on any time frame for crypto or stocks. So you shouldn't have a problem, beginning to immediately take advantage of using this setup. So let's talk about what I meant by it's a continuation pattern. Okay. So you guys should immediately recognize what we have here. We have a rally. We have a rising 20-day moving average that is under price. Perfect. We have a rally stemming from the 20, right? It's coming from the 20. Perfect. And we begin to base. We have our shakeout bar. Remember, what does the shakeout bar tell us during a bullish base? It gives us confirmation that the stock or the crypto is indeed higher. Okay. It's an enhancer. We talked about that during one of our classes. So we have a bullish base at the highs, and of course we have our base breakout. So the initial entry for this trade is for the base breakout, right? This is our entry point. It's over the highs of the base. That's our entry. That's the first setup for this stock, right? But let's say you missed it. You weren't able to take advantage of the entry for the base breakout. Maybe you weren't really confident that this stock or crypto was actually bullish, and you wanted to wait for the next setup. Maybe that's what happened, or maybe you just missed it. You didn't see it. But the 1, 2, 3 pattern then gives us an option to get into the stock or crypto after the breakout, right? So then we have the igniting bar. The breakout happened, right? We broke out. And then all of a sudden we get the resting bar, we get the 1, 2, 3 pattern, and now you can enter over, the highs of the igniting bar here, enter over the highs, and you put your stop loss under the resting candle, and boom, now you have a 1, 2, 3 pattern. So this is going to serve as a secondary entry into the stock or crypto in case you missed out the initial breakout, okay? And in general, guys, the igniting bar, right? We talked about the igniting candle. This usually has to stem from either a base or from a buy setup. Okay, that's why it's igniting a new move, right? This can't, we're actually going to talk about it in a second here, but this can't, you really can't have an igniting candle unless it's coming from a consolidation or a buy setup. You need that, right? And here we have a 1, 2, 3 pattern stemming from a buy setup, right? So let's say you have the rising 20-day moving average that is under price. You have the rally. You begin to pull back. You have your buy setup, where your buy setup entry would be over this candle, right? Stop loss under this candle or under the 20. We have our initial igniting bar, right? The buy setup worked. It triggered. Right, our entry was right here. It worked. But let's say you missed this entry, or maybe you were skeptical that it was really going to work and you decided to pass on this setup. Then it gives you a resting bar, let's say, and now you're going to be able to play it as a 1, 2, 3 pattern where your entry is right over these two candlesticks, stop loss is under this candlestick and that candlestick, okay? So you could see that the igniting candle, right, it always has to stem from either a base or a pullback, right? Because the igniting candle ignites a new move higher. And this kind of brings me to this point. Look at this candlestick. Is this considered a 1, 2, 3 pattern? What we have here, right? We have this green bar, and then we have the resting candle, right? And let's say we continue higher. Is this considered a 1, 2, 3 pattern? And pause your video and really think about it. Okay? So I'll give you guys the opportunity to do that. Okay? And it's not, right? The move was already ignited. A 1, 2, 3 must have an igniting bar that starts the move. We just talked about it, right? This move has already been ignited. We're already up 4 green bars in a row before we get this 1, 2, 3. This is not an igniting bar. This is just, this is really just continuing the move higher. But That's not what we want here. We want the first bar to be an igniting candlestick. It has to stem from either a buy setup, meaning it has to stem from a pullback, or from a base. It ignites. It's really important. You wouldn't believe how many questions I get about this. And they'll give me an example like this, and they'll be like, is this a 1, 2, 3? No, it's not a 1, 2, 3, because this candle is not igniting a new move higher, okay? So let's continue. What's the benefits of this trade? Well, number one, it creates a higher reward to risk setup, right? We talked about reward to risk, but it usually gives us a pretty tight stop loss, which is really, really nice. We know that the tighter the stop, the better reward to risk. And like I said, if you miss the breakout or the buy setup, you could use the 1, 2, 3 as a secondary entry. It gives you another opportunity to take advantage of the trade. And it also, it kind of gives you confirmation. The stock has already proved that it's bullish due to the successful breakout. And you're just trading the continuation of the move, right? This has already proved that it's bullish, right? We broke out. We have the igniting candle. The trade is telling you, hey, we're bullish. We're probably going to continue higher here. And then you get the 1, 2, 3, and boom, you can take advantage of the continuation higher. Okay, let's look at some examples here. We have the 200-day moving average. It's flat and underpriced. Perfect. We actually have a buy setup here, which is, it's not a clean buy setup because of the 20-day moving average, right? It's not underpriced. It's kind of like moving through price. But nevertheless, we have a rally. We have a retracement. Notice how right here, the 20-day moving average starts to point higher. And boom, we get an igniting bar. We get our resting bar. And then we get our triggering bar. And our entry would be over the highs of the igniting bar and the resting bar. So it'd be right here. Our stop loss would go right below the resting bar. And this is a 1, 2, 3, right? 1, 2, 3. Perfect. We could see also the resting bars in the top 33% of this candle. Awesome. Let's look at another play. We have a rising 20-day moving average, right? It's starting to curl higher. We get the wide range bar. We get our resting bar. And then we get the triggering bar completing the 1, 2, 3. So you guys could see this is the definition of igniting bar, right? We're kind of sideways here. It's trendless, right? We're not really doing anything. And we, boom, ignite right out of that sideways trend, and we begin to start a new trend, right? So I guess you can call this a base. It's a really sloppy base. Like, I know I said that you want to have the igniting bar stem from a base or a buy setup, but sometimes you're going to have a sideways trend like this where, price begins to break out of that sideways trend with a large igniting bar. I mean, notice the size of this bar. This bar is bigger than any other bar on this chart, and that's what makes it such a strong igniting candle. Here we have a resting bar. It's not, perfect. Ideally, this would be smaller, but, nothing's ever perfect. Our stop loss would go right here. Our entry is over the highs, and we have the 1, we have the 2, and we have the triggering bar number 3. Perfect. Let's look at another example. This is a really pretty setup. We have our wide range igniting bar. Really, really bullish candlestick right here. We have our resting bar and we have our triggering bar. And this was actually in the beginning of the day. I forget which stock this was, but this igniting candle, ignited the entire move for the entire day. So we could see that off this 1, 2, 3, we continued higher the rest of the day. We have our resting candle, we have our igniting, we have our triggering candle. So let's say you missed the initial breakout down here. You were able to capitalize because it gave you a 1, 2, 3. You were able to put your stop loss under the resting candle and entry over. This is literally, this is a perfect 1, 2, 3 pattern right here. We also have a rising 20-day moving average. We have kind of a flat 200. It's kind of trending, but not a big deal. All right, so let's take a look here. Okay, and this is a really great example of what I said. The 1, 2, 3 is the best continuation pattern, right? We have a base right here. We actually break under that base, right? So we have a base breakdown with this candlestick. But let's say you missed this initial entry short, right? It gave you a 1, 2, 3, 4 actually. So a 1, 2, 3, 4 is the exact same thing exact same thing as a 1, 2, 3, except you're going to have 2 resting candles. So we have our igniting candle, and then we have 2 resting candles before we have our triggering candle that triggers under the lows of, basically all of these preceding candles. And boom, you could have taken advantage of this, right? You would have placed your entry right under the lows here, your stop loss. You can either place it up here or you could place it over this candle, whichever one kind of fits your risk management. I would have probably placed it over this candle just because I like the reward to risk. It makes it a better reward to risk setup. And we actually ended up, having a huge, tremendous drop before we formed for a sell setup right here, and we had another drop.